It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Happy Thursday, everyone. Futures are in the green, erasing its losses on this morning. Ahead of another inflation read we got here. The producer price index increasing 0.2% in March. Wall Street estimated 0.3%. This follows Wednesday's sell-off after consumer prices came in hotter than expected during March.
Bit of a relief here, it looks like, for investors. Well, the next big test for the markets, now that we got two inflation prints behind us, is going to be earnings. Big banks are on deck. JP Morgan, Citi, Wells Fargo, all set to report tomorrow before the bell. So let's get right to it. The three things that you need to know. It's your roadmap for today's trading day. Yahoo Finance's Jared Blickery, Jennifer Schomburger, and Josh Schaefer have more.
Thank you, Shauna. Another read on inflation. Stock futures recovering losses this morning after the release of the producer price index. Now, wholesale prices jumped 0.2% in March from February, and economists average an estimate of 0.3% in their estimates. Now, this comes after Wednesday's CPI print showed an unexpected uptick in consumer prices last month. Investors now pricing in a nearly 79% chance the Fed will not cut rates in June on the back of this latest inflation data.
And the European Central Bank holding rates steady today for the fifth time in a row, as investors still expect the central bank will initiate its first rate cut in June. The ECB holding its main refinancing rate steady at 4.5% and the deposit rate steady at 4%. The decision underscores the growing divergence between the ECB and the Federal Reserve here in the U.S., where hotter than expected inflation data has pushed back expectations for the timing of a first interest rate cut until September.
And investors' tensions are shifting to earnings. JP Morgan, Wells Fargo, and Citigroup unofficially kicking off a new earnings season on Friday. Analysts are expecting America's largest financial institutions to report lower Q1 profits from the year prior. But we'll see if these results overall are enough to ease investors' concerns after the recent market pullback.
Well, today's top story, futures ticking higher as producer price inflation comes in cooler than expected, rising 0.2% on a monthly basis versus the 0.3% that was expected, and year over year, it was up 2.1% versus the 2.2% estimates. Now, this comes on the back of hotter than expected consumer prices and the CPI print on Wednesday. The stickiness of inflation that we've seen so far this year, shaking investors' rate cut hopes. Traders no longer pricing in a 25 basis point cut in June, according to the CME Fed Watch tool. That jump took place yesterday. We were sitting on set here, just absolutely slack-jawed at the jump that we did see from about 42% chance probability of it staying the same to a jump of towards a 72% probability that there will be no cut, no action from the Fed.
Yeah, and this is an interesting reaction here when you take a look at futures. The fact that we are up here on the heels of this print, because yes, it came in essentially in line with expectations, slightly better than what we have been expecting, but you can really, I think, just highlights how nervous investors were for this print, whether or not it was going to reaffirm the inflationary pressures that we saw being reported in that CPI print yesterday. That clearly rocked the markets just a bit. We saw the sell-off immediately after that report was released. So the fact that we are, at least for the S&P and Nasdaq, moving a bit to the upside here on the heels of this print, I think just really highlights the fact that investors continue to try to look for a silver lining in any of these reports. The fact that this report didn't really solidify some of the pricing pressures that we saw in CPI or worry investors even more than they had been worrying. I mean, that's a better way to put it. Yesterday, during yesterday's trading action, that's why we are seeing a bit of a move here to the upside. Whether or not that holds, still clearly, obviously, way too early to tell what today's pricing action is going to look like here. But we're seeing the reaction in the major averages here for the futures market. And then also when you take a look at the action that we are seeing in yields, we saw bond yields pop yesterday on the heels of that CPI print. They're now coming back a bit after this PPI CPI report here. So a bit of a reversal continuing from yesterday's trade.
Yeah, just a brief comment here because we got to separate for this producer price index report where we saw goods production versus services production here. You actually, in goods production, you saw final demand goods edge down. The index for final demand goods edged down 0.1%. So that moved lower. However, you still saw that 0.3% rise in prices for final demand and services here. So moving in opposite directions there, that noteworthy here, and factoring into some of the larger investor calculus out there with this newest piece of economic data out this morning. And speaking of investor calculus, let's head on over to our very own calculus master, Jared Blakely, for more on this morning's earnings reaction, market reaction, and that reversal in the futures this morning as well, Jared.
That's right. We were looking at a bunch of red quotes just a few minutes ago before 8:30 a.m., and this comes after that wipeout yesterday. But I want to take a look at the bond market first and see what's going on with the 10-year. Shauna was talking about that briefly. Now, it's down 4 basis points today, but still holding above 4.5%. This is a 3-month chart, and we got a break to the upside here, and that really kind of spooked the markets. And one area which was hit disproportionately was small caps. Here's a Russell 2000, and let me show you a 3-year chart because we were just starting to poke above this longer-term resistance, but then we ran into this hiccup. And why small caps? That's because a giant portion of them are filled with regional banks, and regional banks do not like this steep rise in interest rates. All that dark red on the screen beside me, that's what happened yesterday. Losses from 3, 4, 5, 6%. But now these little boxes there, these little rectangles with the green, we're seeing a lot of these bounce back. Is it a dead cat bounce? We'll have to see. And we'll be tracking this throughout the day into the close, guys.
All right, Jared, thanks so much. Well, futures are pointing to gains, at least for the S&P and the Nasdaq, after PPI data comes in slightly better than what the street had been looking for. Actually, all three of the major averages here, futures pointing to gains now at the open. Traders, though, have pushed back their rate cut expectations to September for the majority from June. It certainly has been a roller coaster week for inflation data, really a roller coaster of a few months. CPI print yesterday coming in hotter than expected. That clearly spooked the markets. We're seeing some relief here ahead of today's open. Here to break it all down, we want to bring in Stephanie Roth, Wolfe Research, a chief economist. Stephanie, it's great to have you here on set. So at least it looks like in terms of the market's reaction, there is a little bit of relief here today. Do you think that's the right read on that? Why or why not?
Definitely. So when you look at the data, now we're tracking core PC somewhere around 0.24, 0.25, which is very different from the message we got yesterday with core CPI coming in at 0.36%. So now we're tracking a lot better in terms of PCE, which is what the Fed really cares about. Some of the details within the print, especially on the services side, were kind of favorable. So motor vehicle insurance was the story yesterday. That's what popped. That drove a 6 basis point acceleration in core CPI. That came in much more modestly in today's print, came in 0.6%, and that's what feeds into PCE. So, yeah.
Yeah, and so a lot of questions with regard to this as to what additional levers the Fed can pull right now to get this closer to their targets as well on inflation.
Yeah, I mean, June's just a little bit too soon for them to be cutting rates. So we're now looking more like July. The market has certainly priced that in. Today's data is not soft enough to change that narrative by any means. But it is a little bit more a positive signal in terms of at least getting a little bit more progress on that front. It's not going to be convincing enough by June, but by July, we think there's a decent chance that the Fed could actually be cutting.
So did you change your base case as a result of yesterday's print?
We did. So we were looking for 3 cuts starting in June. We had been admittedly, questioning whether June was enough time to really convince the Fed. And yesterday's print was enough to take us over the edge and push us to July.
Stephanie, some were out there on the street yesterday saying, some Wall Street pros were saying that, hey, actually yesterday's print wasn't that bad. They were highlighting some key areas of improvement when it comes to the inflation print there. That silver lining read on yesterday's print, at least, is that realistic at all or no?
I mean, I have to say that was my read of it too, to some extent. When you look at your Bloomberg screen, it doesn't look great, right? You had a beat. The Fed can't really deal with any more beats to some extent and be able to cut in June. That said, when you look in the details, you had deflation in terms of goods prices, which was something people were worried about in February because you started to see a little bit of a tick up in goods. People were wondering if this was going to be a trend. It's not. And then on the service side, a lot of it was driven by things like motor vehicle insurance. And it appears to be a bit of an aberration. My sense is that it will probably reverse in the coming months. And that took core CPI up from, it would have been 0.3 to 0.36.
And so in the areas that we did see decreases in indexes within the CPI report as well, where consumers are clearly pushing back on what prices that they are paying, where then are we starting to see cracks within this broader consumer resiliency story as well?
To be honest, the consumer resiliency story is still in play. The consumer is still fairly resilient. I would say on the good side is probably where you're starting to see a little bit of softness. Sure. That's what was particularly strong in the back half of last year, almost surprisingly so. So now you're getting a bit of a reversal on the good side, and services spending is starting to pick up a little bit. And our base case is you'll have fairly steady consumption this year. And the sort of the incremental driver of growth from this year compared to last year is going to be on the manufacturing side.
When it comes to the risk of recession, if we see no cuts this year, obviously a lot of that would point to the fact that we are seeing resiliency in the economy. Labor has held up much better than expected. Inflation print still running a bit hotter than what the Fed would like there, so a bit of a concern. But in terms of if we don't see a cut this year, if we're looking into 2025 for that first cut, does that at all change the calculus in terms of that rising risk of recession?
The Fed is incredibly data dependent, and to the extent that they start to see cracks, they're going to be very willing to cut. Inflation is not high enough such that if they start to see problems in the labor market, like they would hold off on cuts, which is different from where we were a year and a half ago. Back then, inflation was truly running so high, even if we started to see cracks, there was nothing they could really do. Now the dynamics have changed in a big way, which is why recession risks have come down pretty notably. Even if the timing gets pushed from July to December, that doesn't really change the overall story.
I know that you're an economist, but as we think about the earnings season here as well, and how companies may define the broader kind of macroeconomic equation that they're wading through as well, what do you expect to hear from some of those biggest leaders in the way that they should or could be defining it?
Yeah, we expect to see that margins should continue to be pretty steady. That's been the case for quite some time, which is one reason why we haven't gotten these big layoffs that people had been anticipating. If company margins are elevated, why would they do layoffs? It's been so hard to hire people in this environment. So we continue to see, continued narrative around that. Consumer demand continues to be fairly strong. And then the potential incremental will be on areas like housing and manufacturing sector starting to bottom, and expectations looking ahead could be fairly positive.
All right, we got some layoff announcements to start the year, but perhaps the fact that it's not rolling layoffs that we're seeing continue to move forward, that's a good sign here. Stephanie, thanks so much for taking the time with us. Stephanie Roth, Wolfe Research Chief Economist, kicking off today's show with us in studio. Well, also the European Central Bank, the ECB, as you know them in your hood, holding steady today, holding rates steady as the deposit rate remains at a record 4%. And all eyes are on Christine Lagarde for insight into when the bank might see cuts. Here with more, we've got Yahoo Finance's own Jennifer Schonberger. Hey, Jennifer.
Hey, Brad, good morning. That's right. The European Central Bank holding rates steady this morning for the fifth meeting in a row as it set the table for a potential first rate cut in June as Europe's economy and inflation have sharply slowed. Madame Lagarde saying moments ago during a press conference that some actually wanted to cut rates already at this meeting. The ECB's decision underscores the growing divergence between the European Central Bank and the Federal Reserve here in the U.S., where hotter than expected inflation data has caused investors to push back expectations for when the first rate cut could begin here in the U.S. The European economy is going on a year and a half of stagnating growth with a weakening job market and slowing inflation. Meanwhile, here in the U.S. economy continues to surprise to the upside with a strong job market and hotter than expected inflation. The majority of investors now expect the first rate cut in the U.S. will come in September, scaled back from June on the heels of higher than expected readings on consumer inflation for 3 months in a row. Before Wednesday's inflation surprise, investors had seen the ECB and the Fed, as well as peers in the UK and Canada, moving in tandem. But if the ECB cuts first, that could weaken the euro as well as push down bond yields, causing a greater divergence between the yields on the U.S. 10-year Treasury and Germany's 10-year bond. Meanwhile, separately here in the U.S., New York Fed President John Williams giving a speech just moments ago, offering some reassurances on the back of the hotter than expected CPI number on Wednesday, saying that he expects inflation to gradually slow and that there will be bumps along the way, akin to what we have already seen recently. He says if the economy turns out as expected, it will make sense to cut rates gradually starting this year. So guys, a little bit of assurance there coming out from the head of the New York Fed.
All right, Jennifer Schomburger, thanks so much for breaking that down for us. Well, stocks, they have kicked off 2024 with a bang, but the latest inflation print is leaving investors questioning the Fed's path forward. We saw that reflected in yesterday's sell-off following that hotter than expected CPI print. Well, now that we've got CPI and PPI behind us here, at least for this week, the next big topic and the next big test for the market is going to be first quarter earnings. JP Morgan, Wells Fargo, Citi, all set to report before the bell tomorrow on Friday. Yahoo Finance's Josh Schaefer is here to discuss. And Josh, there's so much riding on earnings season right now, just in terms of the strategists who have come out saying that, hey, it doesn't matter whether or not the Fed actually cuts this year. What's going to be the main driver and what could keep this market momentum here to the upside is earnings. Are they going to live up to those expectations?
The biggest earnings season since last earnings season, right, Brad?
Oh,
and last earnings season was the biggest earnings season since the earnings season before. It always matters.
Because the narrative's the same.
Yes,
right?
exactly.
Yeah.
The narrative is the same. And I think the focus here, Shauna, has been, well, it's helpful, I think, to zoom out and think about why we're talking so much about the Fed and interest rates, right? What we've been talking about is how higher interest rates are going to impact companies and hurt potentially earnings growth, right? And that is something that we've seen companies starting to work through over the last couple of quarters. We had earnings growth on a year-over-year basis for the last 2 quarters, and we're expecting to see a similar narrative play out again this quarter. We're looking at 3.2% earnings growth here for the first quarter. That's according to consensus data grabbed by FactSet. And overall, I think the important thing to sort of highlight here is that right now, consensus does feel like earnings are in good shape. You're looking right now on your screen at who is supposed to lead earnings. That's showing to us that the top 10 companies in the S&P 500 are expected to lead, while the 490 other companies, so sort of Mag 7-ish angle here, are expected to trail. And what that sort of shows us is, for overall what we're looking at for this quarter, we're expecting big tech to do well again and big companies to do well. But the key is going to be, what do the other 490 guide? Because that chart is supposed to change as we go later in the year. We were talking about this earlier this week, right? We're supposed to have a little bit of a catch up from this broadening rally. Do we see that in terms of guidance? Do we hear companies feeling comfortable with potentially higher rates for the rest of the year? Are they feeling comfortable with the rate of inflation right now? And does that change their own projections for earnings moving out into the rest of 24? I think that's sort of the risk and the key question going into the next couple of weeks.
Yeah, it's interesting. And we were talking about yesterday some of the FactSet data and what they were looking for in terms of the S&P 500 actual earnings growth rate and that 3.2% growth rate yesterday. One of the huge things, though, is what the actual catalyst, what the narrative is that many of these companies are expected to talk about. Because they don't have an AI lever to pull. They don't have a blockchain, and I'm dating us a little bit here. Dating, funny, haha. But anyway, taking us back a little bit, a few years there when they were all talking about that. What is the key word that many of them could use?
Yeah, it's interesting. Bank of America was out this morning with their earnings preview, Brad, for the quarter, and they think it's all about, they wrote, quote, it's all about demand now. They think it's starting to become a little bit more of a demand narrative. So again, I was talking about how higher rates impact margins, right? And sort of the different levers that companies can pull there. Well, if we go back a year ago, a lot of what we were talking about was big tech was doing layoffs. Big tech was getting their balance sheet in better shape, right? Big tech was doing certain things to sort of cut back. Well, now, how is that sort of translating into more demand, right? And when you just talked about AI, Brad, how is AI driving more demand for some of these companies, right? Beyond NVIDIA. Who is it helping beyond NVIDIA, and how is it growing their top line? Because at some point, growing top line is going to matter here, rather than just being able to sort of cut down and protect if we're staying in these higher rate environment.
It makes a lot of sense given where we are in the economic cycle, given where we are in the earnings cycle, right? When
the economy is supposed to be doing well, so we should have increasing sales.
Exactly. You should see more stronger demand, and you should see some leverage there in terms of operating. All right. Well, we will see what this earnings season brings. It's going to be a very busy couple of weeks, and certainly we have seen, obviously, some of those best guesses be proven wrong time and time again. Yes. So we'll see if there's any surprises in this earnings season. That's going to really be kicking off tomorrow morning. All right. Well, coming up, speaking of earnings, take a look at this move. Rent the Runway surging after saying it expects a milestone 2024.
Does that mean they're adding a men's section?
They should. I never thought about the fact. You guys don't get it?
I'm not gonna hold my breath
any of
on
the
it.
benefits.
Yeah,
We love Rent the Runway. All right, you can see the stock up nearly 40% in early action. We're going to break down some of the top trending tickers on the other side of the break. Stay tuned.
Let's take a look at some trending tickers. All right, we're going to start on the saucy one. All right, Constellation Brands beating earnings expectations for the fourth quarter and seeing net sales from its beer business jump 11% from a year ago. The company did, however, see a pullback in wine and spirit sales. That fell 6% from last year, citing unfavorable marketplace dynamics. I actually printed out, well, not the whole thing, but the first 3 pages of this earnings report here. And it was particularly interesting. And going further in that wine and spirits business, results aligned with the lowered fiscal 2024 outlook against challenging marketplace dynamics, expects to deliver improved net sales performance in fiscal 2025. We'll see if they can deliver that. Ultimately here, they got a lot of different brands underneath of their portfolio as well. I mean, while I'm doing Duolingo, I'm always having a little Modelo right next to me, because why not?
Why not? It makes it a little bit more fun, you know? But I think that these results are pretty remarkable given the macroeconomic pressure that we are seeing. The fact that we haven't really seen much growth overall for the alcoholic beverage segments, specifically, I should really say the beer segment, right? Yeah. We've talked about less and less people are drinking beer. So many of these companies are struggling. They're looking to diversify their portfolio. When you take a look at these results, they're actually pretty impressive. The fact that they did have an 8% EPS beat, the fact that they are guiding for 12 to 14% EPS growth in the fiscal year, like you just said, ending in 2025. So the fact that these fourth quarter results were strong, despite the fact that we have seen a slowing momentum on a macroeconomic level, maybe it's thanks to people like you. Yeah. Going for that Modelo when they're trying to
learn different languages.
Spanish,
yeah. I mean, I just think you gotta be in the flavor of the culture that you're trying to tap into.
It's probably gonna take you a little bit longer though to be fluent in that language if you're sipping alcoholic beverages on the side.
I don't have a good comeback for that.
Let's take a look at another trending ticker that we are watching, and that is shares of Rent the Runway skyrocketing after calling 2023 a year of significant improvements, and they're also expecting a milestone fiscal year 2024. The clothing rental company is saying that it expects to break even in free cash flow this year. Now, this is a huge reversal given the narrative that we have seen surrounding Rent the Runway and the typical reactions that we have been getting following their most recent earnings results here. So again, this surprised the street to the upside here. They're seeing lots of reason to be encouraged by this print. And as a result of that, you're seeing a massive move to the upside here in shares, up nearly 40% ahead of the open. I am a loyal customer. I think it makes the most sense, but they have really been struggling to expand their customer base and also just charge slightly higher for each of them, which I'm not necessarily advocating on a personal basis, but I do think they have a little bit of room here just in terms of pricing dynamics and potentially exploring that down the road.
Well, they've got more modules that it seems like they've rolled out over the last year that's really unlocked some good growth for them, especially for the amount of customers that might rent something and decide, hey, why not purchase this at a lower price level than what it would retail? So that is something certainly that they've been able to add it on, and ultimately setting the foundation, as Jennifer Hyman said on this particular release, setting the foundation for a milestone fiscal year 2024, and particularly here, as I was mentioning, the premium personal concierge service to style their customers, and then additionally here, more NPS. NPS today, highest level in several years. NPS, Net Promoter Score. It's the amount of people that was essentially recommend your business, or kind of beyond word of mouth, recommend your business to another potential customer out there as well. Spirit Airlines, very low NPS. Rent the Runway, highest level that they've ever seen of NPS. So that particularly is one way that you can look at that as well here.
Yeah,
I just can't wait for men's
results. It makes a lot of sense. I think that you're onto something there. All right, let's also take a look at CarMax, because shares plunging after the company says that, quote, ongoing headwinds due to widespread inflationary pressures has caused it to push back its financial targets here. Now, the used car seller previously said that it would reach 2 million combined retail and wholesale unit sales annually by 2026. Now, though, they don't expect to reach that goal until between 2026 and 2030. So really widening out that time frame there. And because of that, we're seeing a bit of pressure here on shares. And again, profit, sales, they both missed expectations in the most recent quarter. Taking a look at some of the quick reaction here from the street. Truist was out saying that while many investors are positioning CarMax as a cyclical recovery play, the results suggest that that recovery ramp is likely to be a lot lower than what had initially been priced in.
Yeah, there's some red flags within this wholesale vehicle unit, and particularly there where you saw unit sales decline 4%. You also saw the vehicle gross profit decrease 9.4% versus the prior year's fourth quarter, reflecting lower wholesale unit volume and gross profit per unit, which declined $67 to about $1,120. All this considered here, you've got to think about what the affordability challenges are that this company is going to have to continue to navigate through. They talked about that within the release. We believe vehicle affordability challenges continue to impact the fourth quarter unit sales performance. Ongoing headwinds due to widespread inflationary pressures, higher interest rates, tightened lending standards, lower consumer confidence. When are any of these things abating right now?
Well, yeah, especially on the heels of yesterday's print, right?
Exactly.
We talk about the fact that we have seen the odds that the first rate cut here from the Fed no longer doesn't look like investors are pricing in a June cut. More and more are starting to price in that September cut. So as you delay potentially that first rate cut, that's going to keep interest rates high. It's going to continue to pressure the consumer, like you're saying. And names like CarMax are going to struggle a bit as a result.
Yeah.
All right, well, we are just minutes away from the opening bell on Wall Street. We'll be watching some of the biggest market movers and how you can position your portfolio in this potentially higher for longer environment. We've got all that for you when we come back.
Bing bong, there it is. All right, well, must already happened at the New York Stock Exchange. But anyway, there you're taking a look at the opening bell, the NYSE and the Nasdaq, where you've got some virtual funfetti for Solar Bank. And at the NYSE, you've got a live look at, in today's game of how you pronounce this company's name. It's IonQ we are hearing, IonQ, ticker symbol, just like the company's name. All right, well, let's take a look at the opening bell here as we've got some action for the Dow, the Nasdaq, and the S&P 500, all seeing some green, it seems, here to begin today's trading activity.
Yeah, Brett, I think there's some relief here on the minds of investors following yesterday's CPI print, that PPI print ahead of the bell this morning, offering some relief. Maybe the inflationary picture isn't as bad as some investors had braced themselves for following yesterday's CPI print. So as you can see, the Dow opening up just around 70 points. But taking a look at the charting action and what we saw play out yesterday, you see that massive drop lower right after the report was released. That was in the futures market, clearly opened the day lower. That's what we're showing here on your screen. So a bit of a move to the upside, really clawing back some of yesterday's losses here in the rebound. Same is true for the Nasdaq. You can see that on your screen, as well as the S&P 500 there. So move to the upside for the S&P today, up just about 0.2%. Taking a look at the bond market. Now, this is also of note here when you take a look at the direction of yields today. We're seeing a move to the downside, so a reversal from what we saw yesterday when yields spiked on the heels of that hotter than expected inflation print. And then real quick, let's just take a look at the sectors, because we are seeing a lot of green action on the screen. Financials, industrials, the only ones in the red on an intraday basis. You've got real estate and utilities leading the pack when it comes to rebounding from yesterday's losses, Jared.
It's really been interesting to watch the sector action around what's happening in the bond market. And as you were saying with the 10-year T-note, we just had a huge candle that went to the upside yesterday. It was the biggest move in years. That has huge effects on stocks. So real estate yesterday was the biggest loser. Let me show you the 2-day price action. There you can see still down about 3.4% over the trailing 2 days. I'm going to put this back on today. So real estate and utilities, those interest rate sensitive sectors, those are in the lead. Then staples, then energy. Pretty defensive setup here. What's not working, financials down about 0.25%, not a big deal ahead of tomorrow's big bank earnings, but also industrials. The industrials lagging here. And also retail. Retail was spiking in the pre-market. We're seeing a little bit of that action now, but not too much. Let's take a look at some of the leaders here, and we see Korean stocks. That took a huge dip down yesterday. Why do I watch that? Very important to watch that because of the semiconductors. That's a leading indicator. Chinese stocks are doing well today. Cannabis, solar. But let me check in on the regional banks. I've been tracking those since yesterday. We've got some green on the screen, but here's a 2-day view. You can see a lot of losses to still be made up from yesterday, guys.
All right, we certainly do. All right, Jared, thanks so much. Well, speaking of the rebound action that we are seeing here at the open, you've got the Dow, S&P, and Nasdaq all trading to the upside. Now, the move to the upside here, the gains that we're looking at on your screen, follows yesterday's sell-off as investors started to reassess their expectations for the Fed's first rate cut. To break down what potentially higher for longer could mean for your investment portfolio, we want to bring in Wei Li, BlackRock Global Chief Investment Strategist here. Wei Li, it's great to have you here. So talk to us just about how you've looked at the data that's come out over the last 24 hours, and if that is at all, if you're reassessing your positions as a result.
Well, CPI has been hotter than expected, but today's PPI offered some relief. But the big picture here is really that we have been seeing upside surprises on inflation from different pockets of the basket for most part of this year now. And I think markets are really waking up to the fact that we're going to have high for longer in terms of the rate environment as a result of the inflationary environment. So off the back of yesterday's hotter than expected CPI print, we think that June rate cut is perhaps off the table, but this is a Fed that wants to cut rate, as we have seen from their rhetoric a few times now so far this year. So we think that the next 2 inflation prints will be critical in understanding if July is going to be in play, because September is really cutting it very fine as we get close to the election. So this is a Fed that wants to cut, but maybe right now they cannot point to easing inflation pressure as a reason to start cutting, which is why by June is perhaps off the table. But 2 cuts are still likely, and that's what we're going with. And as it relates to kind of the broader risk asset and investment implication, actually, now that we have CPI, PPI out of the way, earnings are going to be so critical. So far this year, we have gone from 7 cuts at the beginning of the year priced in to 2 cuts being priced in now. And earnings have come to the rescue because markets are up year to date despite hawkish repricing. So we'll see if earnings will continue to come to the rescue of hawkish repricing, even as the bar has increased as well for earnings.
As business leaders evaluate what you've put forward, what many other strategists and economists have put forward, in the probability of 2 cuts, 3 cuts this year, how do you believe that the tenor we hear from these CEOs may shift? And what is that core theme that they're going to all be talking about when it comes to the economy?
Well, when it comes to the economy, as we think about what to expect for this upcoming earnings season, and what we can hear from all the CEOs is that we're picking up this theme, this trend of divergence within the economy itself. So on the one hand, we're seeing a bit of a fatigue on the consumers' side, and consumers have really been the bright spot for U.S. economy the last 18 months or so. But as their savings buffer starts to wear thin, we're starting to register some fatigue from the consumers. But at the same time, we're also seeing a bit of a commodity boom, cyclical manufacturing upturn that is coming through in the earnings revision trend as well. So what is likely going to happen in this upcoming earnings season that is broadly positive by way of expectation is that underneath the hood, we're going to see a bit of a divergence, which is why being selective is very important. So continue to focus on sectors that have been delivering quality earnings, not just the laggards as we play US equity market is key, which is why we continue to like AI. We like energy for a bit of a geopolitical diversification, and healthcare we like for better value after the underperformance last year.
Yeah, when it comes to the consensus expectations, it looks like at least for S&P 500 companies for EPS growth, the estimation is just for around 3.2% growth there. So much of the narrative over the recent weeks has been this rotation, the broadening out that we've started to see within the market, and whether or not this quarter's earnings season is going to solidify the fact that that trend is going to continue. And I bring that up because a lot of that's going to be in the guidance of so many of these companies outside of big tech. When you talk about those opportunities, kind of going back off of what you were just saying before, do you expect that to be the case this earnings season? And where do you then see that potentially signaling some outperformance?
Well, we do see a bit of a broadening out of earnings forecasts and upgrades as well. So you talked about slightly over 3% for this upcoming earnings season, but more broadly for the whole of 2024, the expectation is for U.S. equities to deliver 11% earnings growth for this year, which is higher than the historical average of 7%. So expectation is somewhat high. But if you strip out Magnificent Seven, the expectation for 2024 earnings growth delivery is still, we're looking at 8%, right? So there is broadening out beyond the tech champions, beyond the AI champions. And I think that is important as we think about how do we implement US equities. So understanding where the broadening out of the earnings upgrade is appearing is how we want to play the broadening out of the equity market rally. So we have seen, for example, sectors that have the potential to benefit from better AI adoption, right? So we're talking about healthcare, we're talking about industrials that are also seeing a bit of earnings upgrade. And we're also seeing this cyclical manufacturing, cyclical upturn that is likely going to support the next wave of earnings upgrade, be it industrials and energy. So understanding where earnings are likely going to come from is how we think about broadening out of the rally, rather than understanding where the underperformance has been and try to play the catch-up trade based on no fundamental comes through. That's not how we want to play this market at this juncture.
They say time flies when you're having fun. Always fun speaking with you. Wei Li, thanks so much for taking the time here today. BlackRock Global Chief Investment Strategist. Appreciate it. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. About 10 minutes into the trading day, we're taking a look at stocks right now. Mixed for the U.S. major averages. The producer price index in March offering investors some relief over inflation fears this morning. Both the monthly and yearly readings coming in below analyst expectations. But the data comes on the heels of a hotter than expected CPI report. Here with more on sticky inflation and how it impacts Americans, we turn to Michelle Meyer, who is the MasterCard Economics Institute Chief U.S. Economist. Great to see you as always, Michelle. You know,
Great to see you.
You see hot prints like yesterday come through. I wonder what goes through your mind and how you kind of correlate that to the data that you see over at MasterCard, which is, I imagine, just, you know, data centers long worth of data here that you have to evaluate.
Well, I think the fact that inflation is proving stickier, particularly in some of the services categories, is somewhat indicative of the fact that the real economy is also looking stronger. We saw job growth accelerate throughout Q1. We've seen consumer spending accelerate as well. When we look at our own spending pulse data, we are seeing greater spending into March. So yes, I think there's still a narrative out there around a disinflation, particularly for a lot of goods, particularly reversing the inflation that was driven by the supply side. But when you think about the demand-led inflation, there's still some pressure there.
Michelle, is that across the board, or what are you seeing from higher income earners versus lower income earners, and maybe the more pressure that lower income earners are under at this point in the cycle, and the fact that inflationary pressures continue to be much higher than many had forecasted at this point?
Well, look, I mean, always these aggregate numbers are disguising what's happening, you know, in terms of the micro data. So there's lots of different narratives in there. But I would say when you look at the labor market, which is probably one of the best ways to understand these different dynamics by sector, by income group, et cetera, you are seeing wage growth pretty consistent across different sectors, across different income cohorts. When you look particularly at the Atlanta Fed measure that has that really nice breakdown. And job creation has been pretty broad-based. Construction, manufacturing, goods sector is now seeing stronger job growth as well. It's not just the services sector. So to me, of course, there's different dynamics. It's not a uniform economy when it comes to spending, when it comes to inflation, when it comes to growth. But there's nice breadth in terms of what we're seeing in terms of the expansion right now.
Goods versus services, where are you seeing the highest level of spend to continue to remain resilient right now over at MasterCard?
Well, I mean, this story around consumers loving experiences, I don't think that's gone away. And we're really, really keen at the MasterCard Economics Institute to explore that in detail, given the high frequency nature of our insights and our data. So we just yesterday published a blog looking at the Masters, which is going on right now, the golf tournament, to see how the local economy in Augusta is being supported by people going out and spending in restaurants and at hotels, small businesses seeing really important lift, international, folks coming in, tourism, bringing about this big burst of activity. So it shows you that consumers are really, looking for those moments in time to spend. And when they find it, they have the ability to really participate. And I think that's a function of the purchasing power that's still out there on aggregate.
Yeah, I just got back from Augusta a couple days ago, Michelle, and they ran me for a couple pennies for sure. So I can attest to everything that you just said here. I wonder, within the experience economy and where we're also seeing more people tap into online experiences versus going there, is there any moderation that we are seeing in the number of people that are saying, I will travel to go to that event, I will travel to go to that experience, versus saying, if I can experience it via streaming and perhaps just have my fan experience another way that has more digital and more data that's also intertwined into it, that they're making a decision one way or the other?
I think it's both. I mean, I think we have become a more digitized economy in many ways, and the pandemic accelerated that, in the sense of being able to, have these remote interactions. So people do use that, of course, for greater spending power. We have seen, if you look at our spending pulse data, the online spending trends continue to outrun what you're seeing in terms of in-store. But you make a good point, Brad, that the online activity is not just for goods, it also is for part of these experiences. Nonetheless, I think when it comes to, travel trends, you are clearly still seeing a lot of people in action, going, trying to get to those experiences that matter most.
Michelle, always a pleasure to get some of your time. Thanks so much for taking the time here with us today. I know workplace productivity is probably going to start to decline once Tiger tees off in a few minutes now, actually. Thanks so much for taking the time. Actually, this afternoon he tees off. Anyway, Michelle, appreciate the time.
Anytime, Brad.
Yeah. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Well, many analysts are seeing defense as potential sector for growth as tensions continue to rise overseas. Well, one company that could stand to benefit potentially is SAIC. The U.S. defense contractor just reached a deal with the Pentagon to integrate an AI-powered small satellite in its ongoing partnership with spacecraft manufacturer GomSpace. Now, SAIC is looking to strengthen its position in the small satellite market. For more on what this means here for the company and its role and the role that AI could play in future technology in their business is SAIC's CEO, Tony Towns-Whitley. Tony, it's great to have you here this morning. Thanks so much for taking the time to join us. I know you have a very busy day. Your investor day is about to get underway momentarily. So let's start there. Yeah. What is your message to shareholders today?
So the shareholders are going to hear a message about an enterprise growth strategy, a multi-year sort of two-horizon strategy we've created over the last 6 months since I stepped in as CEO, with basically 4 pivots around our portfolio, how we go to market, some of our culture and our brand. And all of that's to accrue to a much more accelerated top-line growth pattern that's going to drive, obviously, to our EBITDA growth. And we're going to continue our practice of converting to cash. We actually lead the market in that area. And so the idea here is how we're growing the company through top line and that's going to increase over the next few years.
AI has been the hot topic, Tony, of the last 12 months plus at this juncture. How do you see that unveiling and really unlocking the next leg of growth for SAIC?
Look, we've got a few things we have to get right. First, in the area of the differentiation of our portfolio. We believe we've locked in. We have a new Chief Innovation Officer coming out of the Air Force, former CIO of the Air Force, who is a former customer as well. But we have identified 4 fundamental differentiators around secure data, around a secure multi-cloud capability, around operational AI and digital engineering. And how we bring those to market in a systematic way is one aspect that's going to drive our growth going forward. Second, quite frankly, we have got to get our business development processes upgraded. There's just some internal operational execution that has to be improved and how we go to market on a more consistent basis. So you'll hear about an enterprise operating model that we've established. And finally, quite frankly, we're making investments not only in our portfolio, in upskilling our talent across the organization, and fundamentally looking up and out into the market where convergence is occurring from national security into the civilian market. What you announced at the beginning of this show, of this segment, is the kind of thing that we do as a mission integrator, the ability to integrate evolving technology, real-time, secure, and mission-critical operations. That's our differentiator. That's our value proposition. And we've got to, quite frankly, substantiate it over the next 3 years.
So, Tony, then it sounds like we should expect more of those types of deals going forward for SAIC as you're looking to turn around the business and really what makes sense in terms of that future strategy of the company under your leadership.
You will see us really pivot towards mission IT and enterprise IT, bringing services and solutions into that space. You will see us embedding more software in some of our more traditional offerings around engineering. And quite frankly, you're going to see a commitment, and the investors will hear today about a commitment to 5 national imperatives. As a company, we're going to take a long-term commitment to drive imperatives that affect not only our customers, but this country. And those are around areas like multi-domain warfighting. Those are around the border of the future, citizen services, next generation space, which is consistent with the message we just spoke about. And then we're going to talk about undersea dominance, which is the support of our undersea efforts in the Navy. We're committing to imperatives. We're going to invest, create solutions, drive thought leadership in those areas, and we'll be positioning again for the long term.
Tony, I'm curious, walk me through how you're navigating a volatile environment when it comes to increased geopolitical risk, what that could potentially mean for your business, and then also take into account even what's happening here with the budget, with the budget environment, which also remains unpredictable ahead of the election in November. How do you navigate what is a very uncertain time, it seems like, ahead for the next several months?
Well, listen, as you understand about the sort of the defense spending, that market, as the threat continues to increase, the outlay environment, we obviously correlate to how we can grow in different aspects of that. But fundamentally, the challenge is the challenge our customers face, which is the budget instability. That volatility puts a significant dampening effect on their ability to look forward, understand the threat, and position for that threat, particularly with technology. Now, to be fair, we got a budget in March that helped to sort of solidify the situation. But as you know, in a continuing resolution environment, that really, with inflation, represents a cut for federal agencies, even though there's a CR in place. So we're hoping that starts to flatten out over time. SAIC's work and our demand signal continues to remain strong, somewhat independent of all of that volatility. There's enough going on within national security and across the civilian government that we feel fairly confident that we can drive an organic growth rate and accelerate that over the next few years.
Tony Towns-Whitley, we really appreciate you taking the time. Best of luck today on the Investor Day, CEO of SAIC. Thanks so much.
Thank you.
Well, when we come back, Madison Mills will be here with me at the top of the hour. We will be continuing to analyze the latest inflation data, as well as diving into the ECB's rate decision with former European Central Bank ECB President Jean-Claude Trichet.
And we're ending the hour with me. I got a chance to speak with New Balance CEO Joe Preston. I'll tell you all about their latest shoe designs, and then I'll be back here at 11 a.m. for Wealth. We'll be discussing the importance of diversification here in your portfolio. Stay with us.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills, and we're 30 minutes into the trading day. Here are our top three big stories. Well, markets, they are still mixed this morning. You've got the Dow and S&P under pressure. The Nasdaq, though, holding on to gains. You've got the Dow off just below the flat line, off about 100 points. Treasury yields, we're also seeing some action there in the bond market and a reversal to yesterday's action. You've got the 10-year yield now off just about 2 basis points after spiking yesterday on the heels of that hotter than expected inflation print.
And speaking of inflation prints, we've got fresh data on inflation this morning with PPI, the Producer Prices Index, coming in cooler than expected, rising 0.2% on a monthly basis, bringing the yearly total to 2.1%. That core reading, which excludes volatile sectors like food and energy, coming in slightly above expectations on a yearly basis, rising 2.4% versus the 2.3% that was anticipated.
And the European Central Bank holding rates steady in March, leaving its main refinancing rate at 4.5% and deposit rate at 4%. The central bank's president, Christine Lagarde, saying in today's press conference, quote, "We are not going to wait until everything goes back to 2% to make the decisions that will be necessary." So leaving the door open to a potential rate cut soon.
And the European Central Bank holding those rates steady for the 5th meeting in a row, maintaining that record 4% deposit rate. This comes as a survey conducted by the central bank showed the demand for credit continued to decline despite banks losing some of their strict and loosening their strict lending standards. Joining us now to react to the policy decision here, we have Jean-Claude Trichet, former European Central Bank president. Thank you so much for joining us this morning. Talk to me about your reaction to not only the decision here, but also President Christine Lagarde's commentary.
Well, thank you very much first to be with you. I would say that the message for me is pretty clear. First, we are going in the good direction, which was confirmed by the last figures that were encouraging, both for headline inflation and for core inflation. Second, we do not want to be pre-committed. So she was trying not to be trapped in, I would say, an overall expectation that the first move down would be in the next meeting in June. So no pre-committing, no pre-commitment. But clearly, she didn't say, don't expect any move from now on. Clearly, we are in a situation where I would consider no more appropriate that the market would put a high degree of probability for a decrease of interest rates in the next meeting of the ECB. But they were very clear, she was very clear, no pre-commitment. We don't take a commitment vis-a-vis.
Jean-Claude, is the cut in June, is that pretty much a done deal at this point, do you think?
No, I would say it's not a done deal because you will have new information. We are living in a world which is quite dangerous, obviously, and anything can happen. We have a world which is marked by geostrategic tensions, war in Europe, war in the Middle East, and expected difficulty also in Asia. So again, let's not forget that we are in a world which is likely, very likely, uncertain, if I may. And after all, we are speaking of a meeting which will take place in several weeks' time. So I understand they are right, and it's appropriate to say we are not pre-committed. But I have to say, looking at the figures in Europe, that I am personally quite confident that they are doing in the right direction. The goal being to be around 2% in 2025. And particularly when I compare with the US, it's clear that now the Europeans are really going at to the target, which is the same in the US and in Europe. In the US, it looks a little bit more complicated and more difficult. Obviously, there is a full 1% difference between headline inflation and core inflation on both sides of the Atlantic, which is something quite substantial. I have explanations for that, of course, but it means that we are not as parallel, if I may, in the decreasing of inflation as we were perhaps before.
Yeah, that's very interesting. And I want to get your thoughts just specifically what's playing out today and compare that to what happened just around 15 years ago. And looking back at your time leading the ECB in 2008, and I bring this up just because some of the similarities that's playing out right now. So back in 2008, when you were head of the ECB, we raised rates ahead of some of that massive stress that we saw play out in the market, and then reversed course relatively quickly. And you made that call because you were remaining data dependent after a hot inflation print. But I bring that up because of the timing conversation that's happening right now when it comes to the Fed and also the ECB. I'm curious from your perspective and looking back now, is there a risk of being too data dependent for both the ECB or for the Fed and for the Fed?
First of all, I would not compare, frankly speaking, the present situation to Lehman Brothers. I would compare the present situation to the first and the second oil shock and to the central bank reaction, which was practicing benign neglect at the time, 73, 80. Then Paul Volcker arriving, Paul Volcker taking the appropriate decisions, but at a level of inflation which was not the present level on both sides of the Atlantic, but which was more of 14%, and he had to increase rates at a terribly high level, 20% for the short-term rates. So we are in a very different situation, of course. As regards the comparison with Lehman Brothers, I would say yes, when you are in very uncertain period of time, it is not absurd to say, well, let's be data dependent, because what is important is that the market participants, investors, savers, economic agents have confidence in the fact that whatever the difficulty, you look at your own goal, your goal being price stability. And I insisted already, I stressed the fact that it was the same goal on both sides of the Atlantic today. After Lehman Brothers, all major central banks, those central banks that are issuing currencies that are in the basket of the special drawing rights, have the same definition of price stability, namely around 2% in the medium run. And to reinforce confidence of the market in the fact that indeed it is your goal is something which I have to say seems to me very important. So I would not be surprised if the ECB decrease rates next time, and if the Fed does not decrease rates next time, even if it is a little bit extraordinary that there is that the decisions are taken in that sequence, if I may, but still they have the same goal, and they have to prove that they are credible in attaining the same goal, around 2% in 25, say.
Very interesting words there. Jean-Claude Trichet, we really appreciate you taking the time and joining us here on Yahoo Finance. We hope to speak with you again soon. Former European Central Bank ECB president. Thanks so much, Jean-Claude.
Pleasure. Thanks.
Well, the big story that we are watching today, rate cut expectations. Investors here in the U.S. and abroad, looking across the pond over to the EU, are hoping for rate cuts in the coming months. Right now, though, traders are betting that the ECB is going to cut earlier and faster than the Fed as inflation in the Eurozone eases more than here at home. So when you take a look at this, Maddie, certainly very different scenarios playing out. And Jean-Claude just laid it out very nicely just in terms of the timing of it, the importance of remaining data dependent. And he doesn't necessarily expect the ECB and the Fed to act at the same time. That isn't necessarily something that should be a bit unnerving to investors. But when you take a look at some of the data right now, clearly here in the U.S. when it comes to the Fed, you got the CPI print yesterday, that hot jobs print not only just less than a week ago, PPI print that came in line essentially with expectations, slightly better than what the street had been looking for. But it does look like, and even looking at the Fed fund futures right now, more investors here in the U.S. pushing off that first rate cut beyond June, and more saying that we might not see that happen until September.
And he made the great point here, and like you said, explained really well that it is a big deal for central banks to bifurcate and diverge on the path to 2%. He said 2% is the goal globally for stability, but the path to get there is going to be different. And we're seeing that in Europe, particularly in England, they're getting to that 2% number a lot more seamlessly than it seems like we are here in the US, bumpy being the new term to describe that path here. But also I thought it was interesting that he said you have to be data dependent because when we're in a confusing time like this, what else are you going to be? That made a lot of sense to me.
Made a heck of a lot of sense. Certainly many, many good points there. And we really appreciate Jean-Claude Trichet joining us here on Yahoo Finance. All right, well, U.S. wholesale inflation rising again last month, but coming in lighter than expected. And that's helping investor sentiment. At least this morning, we're seeing some buying action in early trading here. Well, that PPI print, though, follows yesterday's CPI report, which showed that consumer prices remain elevated. And that was enough for investors to push out their expectations for rate cuts. So where do we go from here? It's a question everyone's asking right now. We want to bring in Christian Lawrence, Rabobank, a senior cross-asset macro strategist. It's great to have you here. So I'm curious just to get your reaction. First, let's start here in the U.S. to the CPI print, to the PPI print. Does that at all change your expectation in terms of when the Fed is going to act and then ultimately how they see that path forward getting back to their 2% goal?
It's great to be here. Thank you. So I would say that when it comes to our Fed forecast, we're currently pricing in around about 2 rate cuts this year, which is now broadly in line with the market. So that's 50 basis points by the end of the year. And we actually only expect another 2 25 basis point cuts next year. So a total of 1 percentage point by the end of 2025. And really, this is a reflection of the fact that the inflation dragon has yet to be slain. We know that there are more cost push pressures coming through as a result of supply chain issues earlier in the year, rising energy prices, which we think will continue throughout 2024. And this is all going to be pretty strong pressure on that side. Meanwhile, when it comes to things like shelter inflation, very little sign of that easing up anytime soon. And we're running at double the pre-COVID trend. I would actually argue that although the plan is to get down to 2%, really we're in a world now where 2% probably isn't the right target anymore. Remember, 2% really came about in the 1990s with the RBNZ, and that was the same time that China entered the WTO. And while we're not moving to a deglobalized world, we are moving to a world where reglobalization is occurring, more onshoring, more domestic production, and that is structurally inflationary.
Well, what's going to make the Fed change that 2% target? They still have stuck to that despite calls like yours to change it. What would make them change their minds?
Well, they certainly won't change it anytime soon. I mean, one could argue that the move to flexible average inflation targeting was a kind of step in that direction. But certainly we'd need to get much closer to 2% for them to be happy to change that or to think about moving, because otherwise it's essentially admitting defeat. Now, when we look at our inflation projections, we do have us going down to 2.5% in the US, but not down to that 2% target over the next few years.
Well, talk to me then about some of the areas where we are seeing softness in this market, because Neil Duddy yesterday really pointing out that we are seeing disinflation pockets across the U.S., particularly when you take a look at the Atlanta Fed wage tracker. We are seeing continuous declines on those wages, which obviously could be a sign of disinflation to come. Is that something that you think this market is ignoring?
Well, I think there are certainly a few pockets of disinflation. In fact, there are some pockets of outright deflation. But I think that those were in the past. So we have seen core goods, for example, being deflationary for a couple of months. And of course, energy prices falling was a deflationary impulse onto the CPI inflation index for some time. But going forward, I think both of those are changing direction. Now, when it comes to wages, this is, of course, the absolute critical point when it comes to that sticky services inflation. And when you look at the structure of the labor market, we did essentially see a mass exodus of over 55s from the workforce. That participation rate dropped quite substantially in the aftermath of COVID. And the likelihood is most of those are not coming back to the workforce. But of course, we have seen a pickup in migration recently. That will mean more workers. That could mean a little bit less in the way of upward wage pressures. But of course, those people also buy things as well, which acts as an impulse on the upside when it comes to the demand element. So it is a very complicated picture, but it's one that I think isn't going to be conducive to that 2% target anytime soon.
All right, Christian Lawrence, Rabobank, a senior cross-asset macro strategist. Thanks so much for taking the time to join us here.
Thank you.
Stay tuned to Yahoo Finance. We've got much more of your market action. Again, it looks like we're seeing a bit of a reversal here in early trading. All three of the major averages now trading to the downside. You've got the Dow off over 200 points. We'll be right back. Stocks reversing course with all three of the major averages lower this morning as investors digest the latest inflation readings. Now, out this morning, PPI data showing that wholesale prices came in a bit better than what the street had been forecasting. And that was a bit of a relief here for investors following yesterday's hotter than expected CPI print. At least initially, it was a bit of a relief. While yesterday's CPI print, it was enough for investors to push out their expectations of rate cuts, many not expecting that first rate cut now until September. So if we are starting to see or will be in this higher for longer rate environment right now, what's the impact going to be on the economy and the odds of a soft landing? To discuss that and more, we want to bring in KPMG U.S. Chair and CEO Paul Knopf. Paul, it's great to have you here at the desk with us. Let's talk about the latest readings, and we also want to get to a recent survey out from KPMG. But when you take a look at the inflationary pressures right now, the fact that the inflationary pressures have remained much more elevated than the last time you and I spoke, just in terms of what we had anticipated that we would see up until this point, how are you navigating this uncertain time?
Well, it's certainly an uncertain time. So there's a lot at play here. The forces behind higher inflation, food, energy, security cost, services cost, no doubt to some degree labor, but maybe to a lesser degree. And then you have all these geopolitical events that are not helping with inflation. To some degree, too, more fragmentation and globalization is creating upward pressure on prices. You know, it doesn't help, too, to have the kind of conflict we have in the Suez Canal area. What happened in the Port of Baltimore, that tragedy, is certainly going to put pressure on prices, too. So there's a lot at play. It's really a very complicated time that we're facing into.
Not an easy time to be a CEO, but I know in your latest survey of 100 CEOs of some of the larger companies, it seems like maybe there's a little bit of optimism out there. Can you talk to us about that?
Oh, there's a fair amount of optimism. So 87% of CEOs were optimistic about the prospects for the U.S. economy, 78 or 79% for the U.S. economy, and equally for the global economy. 72% of CEOs said that they were going to increase either significantly or modestly their hiring in the next 12 months, with only 4% talking about reductions, which aligns well. All the while facing into a lot of geopolitical uncertainty. Cyber is obviously prominent in people's minds right now. And then the tight labor market remains a concern, but also it's something that we've been navigating for quite some time now.
And compare that to some of the risks that were highlighted from CEOs just in terms of some of that uncertainty, going back to what we were just talking about a moment ago. What is on their radar, and what do they see as the potential impact of that if some of those risks do come to fruition?
Sure. So no doubt geopolitical. That's been at the top of the list for quite some time with everything that's happening in the world, particularly in the Middle East, Ukraine. Fears about a contagion effect throughout Asia and potentially parts of Europe. Regulatory concerns remain top of mind in terms of making sure there's appropriate balance to regulation so the U.S. economy can grow in the long term sustainably. There's no doubt there are operational concerns around those geopolitical events that seep into supply chains, and we're seeing a lot of organizations with their nearshoring and reshoring efforts trying to mitigate the risk around that. So there's no lack of risk right now. And then, of course, I think about 60% of the world's economy has elections this year, including the U.S., Mexico, and others. And that is, I wouldn't call it a risk, but it's creating some uncertainty that we're all trying to look at and evaluate and try to determine what the best moves are.
Are you seeing a bifurcation in how some of the larger companies and maybe some of the smaller ones are responding to this moment, not only with all the risks you just mentioned, but also just the general uncertainty? I'm curious because we saw that small business optimism in recent surveys really falling off a cliff. Are you sussing out that kind of difference there?
So B2C feels pretty strong. B2B, business to business commerce, feels soft at the moment. And so that's a real phenomenon. Some of that is just caution in spending around all the uncertainties we face into. So the tight labor markets, maturing debt that's going to have to be refinanced at higher rates. There's a number of reasons for businesses to want to be cautious right now. Many businesses in our survey revealed that 62% of CEOs said that they would wait until after the election to do significant M&A or capital expenditures. So there are just a number of things that we're looking at as business leaders to try to understand where we might be going in the future while still acknowledging there's a lot of confidence among CEOs about the future.
Paul, what about plans for AI investment? Because last time we were speaking, that has been a priority for many of the business leaders that you have been speaking with. What are you seeing in terms of planned investment there, and has that shifted at all?
So the last time we visited, top investment priority for CEOs was generative AI. And that was months ago, last year. And this latest survey said 56% of CEOs are going to maintain that level of investment. So they're maintaining a very high level of investment, with 41% increasing that. 31% of that 41% is actually 50% or more increase in spending around generative AI. So generative AI is a huge investment priority for organizations. We're actually seeing generative AI moving from pilot and use cases to actual implementation at businesses now. Businesses are using it in ways to become more efficient in their operations, more productive, but very much looking at ways to disrupt their own business models and create new revenue streams for their organization. So generative AI is truly going to be transformative. There's no doubt that it's still in a fairly nascent stage, but we're also seeing companies put it in real places to drive efficiencies in organizations and, to some degree, reimagine their business models.
It's interesting to hear that they're already kind of starting to implement it, because one question we've had is, there's all this AI buzz, but is it going to work? And it sounds like it is. Paul, thank you so much for joining us.
Yeah, pleasure being here today. Thank you for having me.
We appreciate it. Paul Knopp is the U.S. CEO of KPMG, joining us here in studio. Now, coming up, President Biden hosted a state dinner with the Japanese Prime Minister last night. Who attended and why were they there? We're going to be back with more after the break. Last night, the White House welcomed Japanese Prime Minister Fumio Kishida for the 5th state dinner of the Biden administration. While policy substance of the evening might have been on the lighter side, the guest list did include some heavy hitters, including Jerome Powell, Jamie Dimon, Jeff Bezos, and Tim Cook. We're bringing in our very own special guest, Rick Newman, to discuss the evening. Rick, I can't
Sorry, I didn't wear my
I was gonna say,
tuxedo.
were you on the guest list?
Why weren't you included? What
I
a big
mean, I
mistake.
was busy though.
Absolutely.
I had something else to do, so I couldn't
You
go
were
to that.
upstate.
Yeah, I couldn't go to that state dinner. Sorry.
Yeah, there you go.
I mean, you know, it's a state dinner. It's not. You're not there to raise campaign donations. I mean, you do that all the rest of the time. A state dinner is something that doesn't happen very often. And you know, if you're the president, you basically want to show off the best your country has. And I think, you know, by my count, there were 4 prominent CEOs there, or business leaders. Jeff Bezos, no longer the CEO, but obviously founder of Amazon. Jamie Dimon of J.P. Morgan Chase, Tim Cook of Apple, and Larry Fink of BlackRock. You know, those are some of the most prominent business leaders in the world. So Biden wants to show them off. There is always, I'm sure, a little bit of business happening on the sidelines. Japan is kind of a stealth ally. Japan is a very important ally for a number of reasons that don't come up a lot. But first of all, as a counterweight to China. Right. And this is only going to get more important in the future as the United States, whether it's President Biden or President Trump, try to figure out how to rein in China's economic power and, if necessary, its military power. I mean, Japan is really important in that. Japan, for what it's worth, got right on board with sanctions against Russia when they invaded Ukraine in 2022. And it's a very stalwart ally. I mean, you know, we still have military troops based in Japan. North Korea is another important issue. This is the problem child of Asia. If something does go south with North Korea, I mean, Japan is going to be a very important ally there. So, you know, very important for everybody to get together and get to know each other.
Certainly a critical ally, like you were saying, but the guest list was very impressive, obviously, and I think got a lot of people's attention just seeing who exactly was included. And like you said, it makes a heck of a lot of sense when you're trying to put on the best presence there in front of a very critical ally.
Right. Another interesting person there, Sean Fain, the UAW leader, where Biden has kind of made this alliance with the union going back to the strike last fall. So that's a little bit of a plum for the union leader.
Yeah, that's an interesting inclusion. All right, Rick, as always, thanks so much. I wish we had more time. All right, well, coming up next on Yahoo Finance, we'll be looking at how the dollar could perform on the heels of the ECB latest rate cut decision, or latest decision, I should say, on rates. We've got that for you after the break.
The European Central Bank deciding to hold rates this morning. Some optimism growing in response to some of the commentary, though, that a June rate cut could still be on the table. And that is in line with what we're seeing here in the States with the Fed to a degree, seeing some actually backing off of a potential probability for a cut in June after that hotter than expected CPI print. And we're seeing the strength of the dollar against the euro continuing this morning. So we're going to bring in Sonia Martin, the head of monetary policy research and FX research, to discuss. And Sonia, thank you for being here with us this morning. I want to start on your reaction to what we heard from President Christine Lagarde this morning, specifically calling out that the U.S. and the Eurozone are completely different areas of the world. They're going to handle the path down to 2% completely differently. Do we buy that?
Yeah, I absolutely buy that. I mean, they're in very different positions right now. And I think she did point out, and I think it was an important point to make, that when you look at the nature of inflation in the US and you look at the nature of inflation in the Eurozone, particularly in recent years, it was quite different. And so, she has to focus on what's happening here in Europe. And she definitely does not want to tie herself down to become entirely dependent on the Fed. So, if the inflation rate continues to decline in Europe, but for some reason not in the US, then that is still a good platform for the ECB to cut rates, irrespective of what the Fed does.
And Sonia, talk to us about the reaction that we're seeing play out in the FX markets, because we had the U.S. dollar once again rising against the euro, not necessarily a massive surprise. But what does that then tell you about how high we could potentially see the dollar push, and the fact that we could see the dollar remain at these elevated levels maybe for longer than we had initially anticipated?
Well, I mean, the dollar definitely benefited massively from the CPI reading. You just mentioned it. I mean, actually, when you look at the numbers when they came out, I mean, they weren't that much higher than the consensus. I mean, the difference was really quite small, but there was a massive market reaction, and it just shows how nervous people have become. I mean, when you think back a few months ago, people were betting on the Fed cutting, 175 basis points this year? I mean, there was people saying they have to start in March, and it seems like now we're going in the other direction, right? So people are now saying the Fed's going to cut less, and in fact, there's a discussion, do they need to cut at all, or can they cut at all? And that's definitely supporting the dollar. So if we see some more pricing out of rate cut expectations for the US, albeit maybe only temporarily, that's definitely supportive of the dollar. Having said that, a lot of the news has been priced in. I mean, in terms of growth, differential, et cetera, that's old news. So I'm not buying the whole parity call thing at the moment.
Well, let's talk about that. If you're not buying the parity call, for a retail investor listening to this, what do they need to understand about what the continued bifurcation of the dollar and the euro would mean for their portfolios, regardless of whether or not we are focusing specifically on FX here? Just in general, what should retail investors know about the lack of parity for those two currencies?
Well, I think that what's really important to understand is that, as far as the FX market is concerned, this is all about relative performance, right? And if you look, and I'm talking now really about fundamental growth. So if you look at Europe, right, and you look at the data in recent months, it's been really, really poor. We have, a recession in Germany. Things aren't looking good. But if you look at what the market is pricing in, that's already in the price. And if you look at the US, the opposite almost is the case. So what I'm saying is that in terms of euro dollar, while there's a lot going on right now, there's a lot of discussion and debate about central banks and foreign monetary policy, actually, I don't think that there's a driver here for euro dollar to move significantly higher or lower lastingly. So we actually have a fairly flat forecast around 108, which looks really boring. But all that's saying is that we're going to probably be quite volatile. But I don't see 120, and I don't see parity. And that's the important point. That would only change maybe if Donald Trump does become president, in which case we have to make a new forecast. But in our base case scenario, that's not the case.
All right, Sonia Martin, always great to speak with you. Thanks so much for making the time. DZ Bank, Head of Monetary Policy and FX Research. Thanks, Sonia. Amazon CEO Andy Jassy releasing his letter to shareholders this morning. One of the big focuses of that letter was generative AI, to no real surprise. But Jassy wrote, quote, that generative AI may be, quote, the largest technology transformation since the cloud. Now, his comments really highlighting some of the excitement that we have seen surrounding AI and that optimism that has swept Wall Street. Well, Autodesk out with a new report today, survey showing that 76% of industry professionals are supportive of AI, trust AI, for their industry. We want to bring in Andrew Anangas. He is Autodesk's CEO. Andrew, it's great to have you here on set with us. Thanks so much for making the time.
Thank you for having me, Shauna.
So let's talk about what you found out from your survey here. We have talked about time and time again. Actually, last time that we spoke, we were talking about AI clearly being a priority for your clients, for your customers. What are you seeing just in terms of their interest in AI and how much they are willing to spend on AI to better position the business?
So the interesting thing about that statistic you just shared is the other statistic associated with it is that 66% of them look to AI as being an imperative for their business over the next 1 to 2 years. So what they're seeing is they're saying, look, if I'm not using AI, I'm not going to be competitive. So they're seeing a connection between their future competitiveness and the use of some of these tools. The simple thing that's happening here, though, is you can't just jump into AI. You actually have to be a digital company and have a digital pipeline to actually benefit from AI. So what that's doing is driving a lot of companies to update their digital infrastructure and get ready for AI. But they really see it as a business imperative moving forward.
Can you talk more about that piece? Because we've been talking about how there's a lot of teasing out of AI, we're investing in AI, but we don't quite know the use cases for these companies investing in it just yet.
Yeah, look, it's very important to avoid the hype. You know, Jon Stewart did a great job skewering the CEOs in Silicon Valley last week. But it's also really important to challenge the cynicism. There's a lot of work going on in AI. Tech's been doing it for at least a decade or more. We've been doing it for a decade or more. That doesn't sound as sexy as self-driving cars or autonomous aircraft, but it's really, really important. Some of the work our customers do takes months to achieve important outcomes. We see an ability to take that down to weeks or days. And we have an enormous capacity problem in the industries we serve. We serve an industry that designs and makes everything. This building, the cars you drive, the roads and bridges you drive across. It's a $30 trillion industry worldwide employing 295 million people. They cannot produce as much as they need to produce right now. There's not enough money, material, or people to build or rebuild everything that needs to be built and rebuilt.
Sorry to cut you off, but my thought goes exactly to what's happening down in Baltimore right now, just in terms of the reconstruction of that bridge. How do you see AI assisting in those efforts, and then what we could learn, or really what this signals about how AI could potentially help with infrastructure investment and productivity then down the line?
Yeah, so I'll give you a real important example of what's going on in Baltimore right now. They're having to engage in this very delicate process of removing the bridge. This is one of these things where AI would be incredibly valuable. Scanning the bridge in real time and then using a highly intelligent trained AI to know how to sequence that out in the most rapid way possible is something that's totally within our capacity and capability today. Now, they're not doing that right now, but that's an example just on the cleanup here where AI-based tools could enable these teams to make much more rapid decisions. Now, in the build process, what it's going to allow them to do is shorten the design, plan, and build cycles and do it in a more compressed period of time. These things matter. I mean, especially with something like that as critical shipping infrastructure.
And Andrew, real quick before we let you go, you were just in DC talking to DC officials there. I'm curious, just the top priority that you think policymakers should be thinking about right now when it comes to regulation and what that means then for AI adoption.
First off, they need to pass the American Privacy Rights Act. It's sitting on their table. Get over their little squabbling differences on the two extremes and pass that. We're long overdue for a national privacy policy in this country, so please do your job. Pass that act. So that's one thing. And also, I think what they need to do is the risk-based approach that Biden's taking with AI, where they're trying to look for high-risk areas and then leave a lot of latitude in low-risk areas. I think that's really appropriate. There's a lot of AI that can benefit people right now today, in our space in particular with our capacity problem. Let it flow, but also manage those risks. Let's not let what happened with social media happen again with AI.
Andrew Anangas, I wish we had more time. So much to get into with you here. We look forward to hopefully having you back on Yahoo Finance soon, CEO of Autodesk. Thanks so much, Andrew. All right, well, coming up, our very own Brad Smith took a quick trip to Boston where he spoke with the CEO of New Balance. We've got the details of that conversation next.
Before a pair of the iconic New Balance 990 can make it out of the box and onto your feet, more than likely, it was boxed here in Lawrence, Massachusetts. New Balance, the third largest sneaker brand in the United States, is privately owned and has a made-in-USA operation unlike any other sneaker and athletic footwear manufacturer. At its helm is Joe Preston, and he's hedging his bets against an eventual dad shoe decline with consumers.
They're looking for new, they're looking for fresh, they're looking for authenticity. Those are all elements that we're trying to deliver and present to them.
Preston began his career at the company in 1995 as a senior product manager and has risen up the ranks, being promoted to president and CEO in 2018. Even with its success and popularity, New Balance places fourth behind Puma, Adidas, and Nike. But when it comes to revenue growth, New Balance has outpaced all three giants with a 23% increase between 2022 and 2023. That growth, fueled by the demand for retro sneakers, selling directly to consumers, brand partnerships with world champion athletes and music superstars, and international growth, has put New Balance on the map in virtually every corner of the world.
I look at our competition and I see opportunity.
We met with Preston at New Balance's Sports Research Lab in Boston to unpack how he plans to unseat their competitors and his vision for the brand's next evolution. Since 2021, New Balance's revenue has grown around $1 billion a year for the last 3 consecutive years, hitting $6.5 billion in annual sales in 2023. Preston's goal is to hit $10 billion in sales in the next few years. But can he maintain New Balance's momentum and stay in the athletic shoe race, let alone win? Preston is banking on innovative materials to get New Balance across the finish line. When you think about your top priorities as CEO, what comes to mind for you?
We've been on a growth trajectory here for a few years now, and you want to make sure your systems and your processes can hold up to that growth.
What is the product that excites you the most right now that you know is coming out of facilities like this?
It's probably the one I'm wearing, this SC Elite.
Okay, pop it up there so we can
there we go.
So we can see it. This is the Fuel Cell Super Comp Elite V4. It has a midsole made with PIBA, or polyether blockamide, a lightweight and bouncy foam that's known for its energy return and responsiveness. This is the material Preston sees as the next big win for New Balance. I had the opportunity to test it myself.
We're going to be able to capture all of the force that your foot is putting on during your run. We have 20 plus cameras around here, which will be able to capture your form.
I feel like it's rolling perfectly with my foot too, as I'm making contact to the ground. So you've got so many different sensors that are in this room. How do you take all of that data and synthesize it into what's going to be best for the athlete?
Well, you have the quantitative data from the force plate, the qualitative data from the cameras and from conversations. You package that together, right?
We want to make sure that we're getting that comprehensive look at you as a runner. That combined with the quantitative data is really how we can package something to our designers to say, this is what we might want to change or influence.
New Balance needs to find a new home run to replace its iconic dad shoe. Preston is investing in materials like PIBA to drive the company's growth. What is that next chemical compound that you're really experimenting with now that gets you excited about the future for New Balance?
We do believe that the next big revolution is going to come in materials. I fundamentally believe that, and I think it'll come plant-based or something that will revolutionize the industry.
Creating the next material that will transform the athletic shoe industry is not without obstacles. Just last year, Nike filed federal lawsuits against New Balance and Skechers for patent infringement. The lawsuit says that New Balance has likewise used Nike's Flyknit technologies without authorization. Nike claims New Balance's Fresh Foam fuel cell and other lines violate their patent rights. What goes through your head when you have companies that are trying to say, hey, you guys copied what we're trying to do?
Intellectual property is a key element of a company's assets, so we want to protect our assets. And likewise, if we feel companies are overstepping their bounds when they come after us, then we're going to defend ourselves.
New Balance and Preston are betting on a future where technology, materials, and design mesh together to create the shoes of the future. Like its competitors, though, that also means keeping customers fitted in cool, retro kicks like the 990.
We have the 990, the original 990 or the 996 here. Fashion can ebb and flow, but this remains a core item for so many people around the globe.
The 990 V1 debuted in 1982 and is now in its 6th iteration. The sneaker is a part of New Balance's Made in USA running line, meaning it contains a domestic value of 70% or greater. And it's been a perfect storm of consumers looking to spend, plus sneaker culture reinvigoration over the past couple years as well. Have you ever woke up one day and just thought to yourself, why is there so much popularity, or were you shocked by the market demand for silhouettes that debuted in the 80s and 90s?
There's always been an appetite within athletic footwear to look to the past.
New Balance, a more intelligent approach to building shoes. Why don't New Balance shoes come with pumps, discs, or other gimmicks to make them fit better? Because they fit better to begin with.
If you go back into our archives and you understand that these products that were introduced were state-of-the-art, the 990 was the first $100 running shoe, and there's multiple models in there that were worn by the best runners in the world. So that's a discovery item, and I think our designers do a great job of developing new product and then taking some of our old classics and reimagining them, and the consumer is really gravitating towards it, and we're seeing it in our Google search, which is up significantly and has been for 3 consecutive years.
Those trends even extend to StockX. According to the online marketplace reseller, New Balance is among the top 16 retro and running silhouettes shoppers were obsessed with in 2023. The New Balance 1906D had the second biggest year-over-year spike in searches on the site.
Sydney has, she's a world record holder, and she comes into the Olympics as the reigning champion in there. So this has been designed with her and our innovation team.
Consumers are also gravitating toward New Balance because of their brand partnerships, a business strategy New Balance has had a fickle relationship with.
We do have a history beyond running with athletes. We were the first ones to sign an NBA player to $1 million contract. It was James Worthy back in the day. And then we went away from endorsements for quite some time.
By the late 80s, they were out of the sponsorship game, adopting an endorsed by no one philosophy.
At New Balance, we don't pay celebrities to wear our shoes.
We got back into it through baseball. Today, about 20% of Major League players wear New Balance.
And since 2018, New Balance has seen significant wins with their sponsored athletes like Coco Gauff, Shohei Ohtani, and Sydney McLaughlin. How have athlete partnerships really helped with New Balance's story in success and a broader turnaround as you remain relevant with consumers?
I definitely think it's helped us get the brand younger.
It appears teens are gravitating toward New Balance. According to a 2023 Piper Sandler survey, New Balance surpassed Vans as the #4 favorite footwear brand, gaining about 200 basis points of mindshare year over year.
I think you want to find athletes that you believe share the same values that you have as an organization, and I think we have. But you have to do it in a meaningful way. So every single relationship that we have with an athlete or with an ambassador, we make sure that it's curated so it's not just a roster, that we're bringing their stories to life.
Although New Balance is a Boston-based brand, it's also a global powerhouse with over 4,000 retail locations worldwide, more than Nike and Adidas combined. And before becoming CEO, Preston spent several years managing the brand overseas as Vice President of Asia Pacific and Executive Vice President of International. He says that time shaped his leadership style significantly.
That's where I learned that the role of a leader is to enable and facilitate, not audit and control. So enable and facilitate is how I would describe my leadership.
We finished 2023 at $6.5 billion. About a third of it's in the United States, about 2/3 of it is outside of the U.S.
Earlier this year, New Balance celebrated 35 years in Japan, a partnership that dates back to 1988. how did that influence the decisions that you brought back to the U.S. as well?
Well, everyone's goal is to be a global brand. The top sellers are the top sellers everywhere. But that doesn't mean the consumer is getting the information the same way. It doesn't mean they're getting the right cues. So you got to make sure that those nuances are in place so that you can benefit from it.
When you think about the next 5 years and being able to continue to top the results that you've seen here, is that sound daunting to you?
Our future's bright. We have so much room to grow in every single market around the globe. In the areas that we are in, whether it's basketball or global football or baseball or running. So we're just trying to stay focused on that. And if we do that, we think we're going to be able to continue to grow.
You and I have talked at length in the past about whether or not we could ever see a New Balance IPO. Deckers made their way public and has seen the success with some of their brands. Is this the opportunity where, in the legacy of Ann and Jim Davis, they say it would be nice to maybe take a company public?
They've had the company private since they purchased it back in 1972. That's over 52 years ago. The company was founded in 1906, has been private since then, and I think that's going to continue.
And Brad Smith joins us now to discuss. Brad, amazing piece, obviously. Congratulations on getting it out here. What can you tell us about what you learned through getting to have so much quality time with Joe Preston about the brand?
I mean, that was an amazing amount of time that he and the team were able to set aside, provide to us, and the amount of locations that we went to, some of it was featured within that 11-minute cut. There's a longer, extended, the director's cut that I can't wait for folks to see as well, where they're going to see even more of us being able to go into the factory, the Lawrence, Massachusetts value stream at New Balance, where end to end, from the amount of time that a person has and one of their team members has hands on or on a machine, this shoe, it can get made in 45 seconds, a pair of shoes, essentially, at the end of the day. So all of these things considered, that's the type of output, the production that they've really been pacing here at New Balance in order to meet the demand and meet the moment where they found everyone from some of the different digital collaborators and athletes and different famous people out there like Taylor Swift and Jack Harlow wearing their shoes, whether organic or whether partnered, where they've been able to meet that moment here, and all because of some of the leadership of Joe. And Joe is, and I mentioned this within the story that's up on the Yahoo Finance platform now, he's a first-generation American citizen within his family. His parents immigrated here, migrated here in 1959, I believe it was, and so it's an amazing story of his own hard work, grit, and now the CEO of one of the major companies producing athletic footwear and apparel in this world.
Great job on this, Brad, and I think this gives our viewers just so much insight into the value of the New Balance brand and where the company really sees that direction moving forward. Again, you can find Brad's piece up on yahoofinance.com. Great job, Brad. All right, let's do a quick final check of the markets. We're still looking at a mixed picture. You got the Nasdaq holding on to gains, Dow and S&P, though, in the red. Wealth with our very own Brad Smith coming up next. We'll see you tomorrow.
Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of guests and experts will give you the resources, the tools, the tips, the tricks that you need to grow your money. And on today's show, we dig into two big inflation reports and how they impact your finances. And Americans are feeling the pinch of auto insurance costs. We break down just why. Plus, how to handle your money. We reveal the differences between two kinds of common investments out there. Our top story today, though, the newest read on inflation. The Producer Price Index, or PPI, came in just below estimates this morning, increasing only 0.2% for the month, and then rising 2.1% annually. That's on the heels of hotter than expected inflation report on Wednesday, that CPI report that we broke down for you. So let's bring in our very own Jared Blickery, who's standing by to tell us how the markets are digesting the economic data from this morning. Hey, Jared.
Hey, Brad, bit of a different reaction today. Those PPI numbers basically in line with what the street expected, and we're bouncing back in the stock market, although it's a mixed day here. The Nasdaq in the green, up about 0.33%, S&P 500 and the Dow slightly in the red. But I was watching the reaction in the bond market yesterday. I think this is really instructive. This huge candle here, that's about 18, 19 basis points in the 10-year yield, all the way up to 4.57%, crossed a very important threshold, 4.5%. And if I show you the last year, let me put a line chart here, you can see we've just been in this trend channel. We are now at the upper end. And another way to look at this is just a break to the upside of that 4.5 level. We'll have to see if we can get all the way to 5, but that would be the next logical title, or that would be the next logical target there. Now, I just want to show what has happened over the last few years. This goes back to the pandemic beginning. CPI reaction days versus the S&P 500. In purple, we have SPY. That's the S&P 500. In cyan, we have the reaction. Those are CPI days. You can see they have roughly tracked the general market, but CPI days stalling out here. What does that portend for the future? Just something to think about. Also want to point out that the Federal Reserve was busy slicing and dicing inflation into various subcomponents to show that inflation was moderating, but now those subcomponents, like Supercore, have accelerated to the upside. This goes back to 2017, but the 3-month number on Supercore CPI is now 8%. That is a far cry from the Fed's 2%. So perhaps even 2 rate cuts is a little bit too much to expect this year. We'll have to see, Brad.
Jared, thanks so much for teeing up our next conversation here as well. Continuing on the thread, wholesale prices in March came in better than analyst expectations, but it's not stopping investor concerns over the sticky inflation that we saw in Wednesday's CPI report. Taking a look at the major averages, an hour and a half into the trading day, we're mixed right now. The Dow is off by about 200 points, 0.5% there, and declines. S&P 500 down by about 5.6 points. We'll round that off to. And then the Nasdaq Composite still holding on to some gains right now. So as prices continue to pinch the wallets of Americans, what could be a good way to protect your finances? Joining me now to discuss is Mike Remack, who is the head of investments of Citi Global Wealth at Work. Great to have you here in studio with us, Mike.
Great to be here, Brad.
Certainly. You know, as we're digesting all of this economic data that comes through and gearing up for an earnings season that could prove to be volatile depending upon what companies have to say about the current economic environment and demand trends that they're seeing, a lot of people are trying to figure out how to diversify their wealth and how to safely navigate the equity market as well. What are you telling clients right now?
Yeah, absolutely. I think on a week like this with so much economic data coming out, it's important to take a step back and really think about what it means as an investor. And the backdrop is really one of economic growth. So even the Federal Reserve last week with comments, they expect economic growth to continue through 2026. And you look at this inflation picture and, we've really seen inflation come down from about 9% down here into the CPI report from yesterday, which is in the mid 3s. Now, it spooked investors that the print came in a little bit hot, but I think it's also important to point out that there are different measures of inflation. And the Fed even looks at a measure called the PCE, which will come out later this month. And, that PCE indicator could show that inflation has come down even more. Bottom line is our view is that we expect inflation to trend down into the 2.5% range by the end of this year. And that's a pretty good picture when you combine that with a healthy jobs market. We think it's still going to give the Fed some room to cut rates before the end of the year.
With the view that inflation will continue to trend down then, and other people trying to figure out how they position their portfolio accurately for it. What is the best portfolio positioning with that trend?
Well, the nice thing about this backdrop that I just described is that the cost of being diversified has gone down quite a bit. So as an investor, of course, your asset allocation is the primary driver of your returns. Getting that right is important, but this is a very, very different market than we saw a couple years ago. A couple of the key factors would be, one, a big reset for financial markets in 2022, one of the worst markets in history for a diversified portfolio. We saw the stock market, come down considerably, and bonds, of course, got crushed on the back of rising interest rates. You look at where we are today, you've got a bond market that is very attractive, that pays investors very well for relatively low risk, and there are opportunities across the fixed income continuum. In equities, last year was really about the Mag 7 and this rally in tech. And so if you look kind of under the hood of the equity market, still a broad swath of stocks that remain at relatively low levels with opportunity for a broadening out.
Some of the risks that still remain present. I mean, it's a massive election year just across the world right now. You think about the number of people that are going to be heading to polls in one way or another. Where and how do you rank some of, whether it be the geopolitical uncertainty, whether it be people going to elections and what the outcomes of those elections could be? How do you rank risks in this environment right now?
Yeah, look, the risks are always out there, and you've got known risks like the election, like this inflation picture and what that means for the Fed. And of course, the things that always tend to rock markets are the unknown risks.
Right.
And diversification is a great way to protect a portfolio from those short-term shocks. One of the things that I think about is that the U.S. stock market 15 years ago was 50% of global GDP. Today, it's 70%. Now, we don't think that the U.S. stock market is going to go to 90% of world GDP in the next 15 years. And what that really means is, it can pay to diversify a little bit outside of the U.S., to not have such a U.S. focus. But we do think that it will be important for investors not to get too sucked into the headlines around politics and policy, understanding that this is a pretty good economy where there's still a lot of value in the market.
To what extent does diversification mean taking a risk assessment and looking at some assets that people might not have previously tapped in? And naturally, people's minds might go to things like cryptocurrency or whatnot because of the new SEC, making sure the new SEC allowances of new crypto ETFs and whatnot. How much of that risk assessment is being done by your clients and saying, yeah, this looks like a risky asset right now, but what type of exposure should I be adding on?
I think it's a great question. I mean, we have a saying where I work, it's more core, and it's really about the idea that you want to have a core diversified portfolio, that's really where you're going to build your lasting wealth over time, getting that asset allocation right. Look, many investors are going to want to play at the margins, take some opportunistic bets, maybe at the outside 10% of their overall portfolio. But we would caution against going too heavily into some of those speculative trades.
Mike, great to have you here in studio with us. Thanks for kicking off the show.
Thanks for having me.
Absolutely. It's Mike Remak, who is the Citi Global Wealth at Work Head of Investments here on Wealth on Yahoo Finance. And coming up, we'll jump into the auto space, how the recent inflation report is impacting autos, and what to do about that rising premium. That's right after the short break. let's get to the world of autos. CarMax shares plunging after saying uncertainty in the timing of the recovery in the market caused it to push back its financial target. The used car seller previously said it would reach 2 million combined retail and wholesale unit sales annually by 2026, but now expects to reach that goal between 2026 and 2030. The company sold just over 765,000 vehicles in fiscal 2024, which was down over 5% from a year ago. Its combined total vehicle sales for fiscal 2024, which includes wholesale vehicles, came in just over 1.3 million. The results also driving shares of Carvana down this morning. There you're seeing both ticker symbol KMX, CarMax, that's down by about 13% right now. Carvana also down. CVNA is the ticker there. That's down by a little more than 3.5%. While car prices are dipping lower, more Americans are still feeling the financial pinch from car ownership thanks to higher auto insurance costs. Here to break down how auto costs are weighing on the latest CPI data is Yahoo Finance senior reporter Alexandra Canal. Hey, Ali.
Hey, Brad. Yeah, it's been very interesting to track the price action in autos, especially since we saw such high new and used car prices over the past few years. There has been disinflation on that front, but we're now seeing that high car inflation spill over into other autos-related services categories. To that point, autos insurance surging 2.6% month over month. That's the hottest it's been in quite some time. And aside from shelter, it was the main reason we saw inflation come in hotter than expected for the month of March. Bloomberg economist Anna Wong noted that car insurance alone added 0.6 percentage points to CPI. And you can see on the chart that she highlighted that we saw the surge in prices for new and used cars, vehicle repairs, and vehicle parts peak earlier and then come down. We're now in the peak for autos insurance, so that is expected to come down over time like those other categories. Year over year, we are up 22%. So a lot of this is timing. There's simply a lag. That's the argument FundStrat's Tom Lee made, saying there's not much the Fed can really do to correct this, given that it is largely a timing issue. Autos insurance is a component of transportation services, which increased 1.5% month over month. You can see how significant the boost was from February to March for those car-related services, with that motor vehicle insurance driving the bulk of the uptick there. So bottom line, this is timing. It's not panic mode, according to these strategists. In fact, auto insurance and PPI, which is what goes into the Fed's preferred inflation gauge, PCE, that came in much cooler than CPI at just 0.1%. So the narrative here is that this is not broad-based inflation, but we will have to wait and see.
All right, Ali, thanks so much for teeing up this next conversation as well. One of the big numbers that popped out in Wednesday's CPI report was auto insurance costs, prices increasing over 22% in the last year. So why, just why, has your auto insurance premium got so expensive, and is there an end in sight? To help answer some of these questions, I'm joined by Loretta Waters, who is the Vice President of Media Relations at the Insurance Information Institute. Loretta, let's start with the why. Why have prices gone up on auto insurance, and is there any easing in sight?
Well, year over year change in vehicle premiums have happened. 2020 was, we had the pandemic, and here we saw rates going down because people weren't driving as much. But that changed drastically because more and more people became, while there were less people on the road, there were more people driving crazy. I mean, the cost of auto claims soared since the pandemic began in 2020. So that's what we're seeing. We're seeing more accidents, higher repair costs. Escalating medical bills are the primary cost drivers, too. We have an increase in litigation claims that have contributed to higher auto insurance claims payouts. And then, of course, we've had U.S. auto insurers cumulatively paid out $1.12 in claims and expenses for every dollar of premium written in 2022. So those are some of the key factors here.
You also, within your key factors, you mentioned auto thefts as well. What are we seeing there? Is there any kind of delta, any change that we're seeing year over year? And what types of models can people avoid perhaps purchasing so that they don't see these auto thefts happen to them?
Yeah, auto thefts are another cost driver. Nearly 500 vehicles were reported stolen nationwide in the first half of 2023, so making that an increase of more than 2% compared to the first half of 2022. And that's according to the National Insurance Crime Bureau, who provided those statistics. New York had a 20% increase, and Illinois had a 38% increase. Ohio was the third largest with 15% year over year. And some of those factors are certainly like cars, like the Kias and the Hyundais. We're seeing losses in those areas. They're still happening. We're also seeing things like airbag thefts, and catalytic converters is a big one. You see a lot of people, these catalytic converters stolen because of the metal that they have, the precious metals. So the problem is not just the catalytic converter itself and the removal, but there's often a lot of damage that goes with those cars. So we're seeing a lot of damage in that area.
Loretta, people want tips. They want to figure out what are the best way to reduce their auto bills. How can they start that right now?
Well, certainly one way of doing that is to, bundle your policies, your home and your auto, sticking with the same company, being a loyal consumer, that's a help. Shopping around for your car insurance, prices differ from company to company, so it pays to shop around. And really, if you're buying a new car, compare costs before you buy a car. Auto insurance premiums are based in part on the car's price, the cost to repair it, overall safety record, and the likelihood of theft. So many insurers offer discounts for features that reduce the risk of car theft or personal injuries, which of course is a big issue. So, when you're comparing new or used vehicles to purchase, research what the cost will be to insure it. Raise your deductible is another way. By choosing a higher deductible on your car insurance, you can significantly lower your premium costs. And of course, you want to make sure you have enough money set aside to pay the higher deductible in the event you do have to have a claim. And another one, of course, is maintaining a good credit history.
Right.
You want to establish a solid credit history, and that has many benefits, including lower insurance costs.
Loretta, just lastly,
Yeah.
I'm sorry. Just lastly, while we have you, a lot of people trying to consider for their own household, for their driveway, for their garage, if an electric vehicle is right for them. And we've all heard some of the pitches as well for electric vehicles, more data that goes into them. That data can then prove if you're a safer driver or maybe not, and perhaps lower or at least alter some of the costs that you're seeing in auto insurance premiums. Are we starting to see that yet? And if so, or if not, when could we start to see that come through?
Yeah, that's a good question. Yeah, telematics are a big issue where a consumer can have that installed into their car, and it will gauge what you're doing, how you're driving. Are you speeding? Are you taking a curve really high? All those factors show what kind of behavior you are as a driver. So if you are willing to do that, want to take that, and a lot of people are starting to do that, they feel that is a good way to save money, and it also helps you to become a better driver.
Absolutely. Loretta Werters, who is the Vice President of Media Relations at Insurance Information Institute. Loretta, thank you so much for taking the time here today, helping people with some of these auto insurance costs out here. Pesky, thank you. The pandemic may have dramatically impacted relationship statuses, and that can have lingering financial ramifications for independent tax filers and wealth builders. Some quick numbers for the ladies out there as well, specifically. In 2022, there were 43.5 million single adult women in the U.S. That is the highest level ever, and up from 37 million just a decade earlier. That's according to the U.S. Census Bureau. Further, as it relates to retirement here, evaluating the average Social Security benefits for men and women, you can see men receiving almost $400 per month more on average. Bringing in Yahoo Finance's Carrie Hannon with more on this. Because, Carrie, there's a lot to break down at the end of the day, and we got to think about where this is really playing out for women and the different rise that we've seen now in the number of single women as well.
Yeah, Brad, thanks a lot. This is a big subject. It's a very big concern for single women. A study I popped on this week was the St. Louis Fed had one just focused on single women who had not been married before, divorced, widowed. These are single women, and they say they have a significant less wealth accumulated. So this is something women really do need to pay attention to. And the thing is, it's like a triple whammy, right? For starters, women, we still have this persistent pay gap of around 84 cents to our male counterparts. Women tend to step out of the workforce for caregiving for children or aging adults. And Goldman Sachs has a recent report that shows that about 40% of women do step away for at least a year to do this. And this is important, this stepping away from the workplace for caregiving, because not only are you not contributing to your retirement accounts, you are maybe missing bonuses or raises, and you are also more than likely allowing women shift to part-time work at this point, perhaps, and you're not going to have an employer-provided retirement plan, which we all know makes it so much easier to save for retirement. New York Life has a study that showed that a quarter of single women do not have retirement accounts. This is something to pay attention to. So you have those two things against you. The third strike is that women tend to live longer, on average 6 years. So you have a longer time span to need to finance those extra years than your male peers do. And the point is, you have no one, you just have yourself to lean into, right? There's no fallout income here that you might be able to fall back on with a partner supporting you. These are important to remember. Women also, Brad, I hate to rattle on here, but to often get a later start saving for retirement, single women in particular. And one of those reasons is student loans, right? And a study I saw shows that women take on average 2 years longer than men do to pay off their student loans. And I'm putting that down to lower income, right? The pay gap, once again. So these are some things, and you mentioned at the top there that the resulting of the lower pay, the time out, is the smaller Social Security checks moving forward into retirement. So those are the things that are top of mind, and I think single women really need to pay attention.
Carrie, thanks so much for putting a spotlight on this report, this study that you came across, and some of the key takeaways from it as well. Hopefully we've got some more actionable tips from you as well as our guests coming forward here on Wealth. Appreciate it. Coming up, you're on your computer trying to pick out some investments and you see many options. So how do you distinguish them at the end of the day and choose what's right and wrong? We bring in an expert after the break. Wholesale price inflation came in a bit cooler than expected this morning, but still remains a bit elevated. So, as inflation seems to be here for the long haul, investors are looking for different ways to hedge against these rising prices, but there are so many different kinds of assets out there. So today, we want to zoom in on two kinds, ETFs and mutual funds, and see the pros and cons of each. Here to help us do that, we've got Joel Dixon, who is the Vanguard Global Head of Advice Methodology. Joel, all right, can you start by breaking down the difference perhaps between an ETF and a mutual fund for us?
Sure. So first of all, I think it's really important that mutual funds and exchange traded funds, or ETFs, are not different investment strategies in and of themselves. They are different ways to access strategies. So whether you're trying to get exposure to large cap US technology stocks, or an S&P 500 index, or corporate bond portfolios, you're probably able to do it with either a mutual fund or an ETF. The differences often come in how you access those investments and those strategies.
Certainly. And so what are some of the fees then that are associated with mutual funds versus what we've typically come to understand with ETFs?
Well, one of the main differences is that the ETF structure kind of built up through so-called index fund products. And while that's expanded over time, it was different than how the mutual fund industry kind of grew at its inception, which was through kind of actively managed fund selection or manager selection approaches. And so the fees involved in those types of investment strategies differ. That being index fund strategies, by and large, are lower cost in terms of ongoing management than actively managed strategies. The trade-off being, of course, that you may get value from the actively managed strategy over and above the cost, and that's kind of what you have to assess. At the end of the day, though, cost is an important variable to consider, or important element, because every dollar that you pay in cost, whether it be what you're paying the manager to run the fund, whether it is transaction costs, or even the taxes that you might pay from your investments, every dollar you pay in those forms is $1 less that you can spend in your future to meet your future goals.
We kicked off the show starting to talk about diversified portfolios. How should someone in their attempt to have a diversified portfolio, and if they are looking at a mutual fund, decide when it is time, or if it is time, to add a mutual fund or an ETF to the portfolio?
Yeah, I mean, this is all about how are you thinking about structuring your own investment portfolio in terms of the strategies that you want and the exposure to asset classes that will allow you to meet your long-term goals. So, if you're more risk averse, you're worried about where the market might be headed, you might have a little bit less exposure to equity strategies in the form of mutual funds or ETFs. Than if maybe you're thinking longer term investment and approach, where maybe having equity strategies and you can tolerate the ups and downs that are invariably going to occur in the markets. So it's all about building a diversified and, I would argue, low cost portfolio that is set up for different market environments, the uncertainty that is inevitably going to occur, so that you can meet your goals over the long term.
What's a healthy performance barometer? What type of return should you be seeing up against some of the other assets that you may have invested in that sit within that portfolio, especially if you're just gauging it up against the broader market?
Yeah, it's really hard to sit here and be able to say predict returns. Mm-hmm. Returns are inherently uncertain and something the investor, you do not have control over. What is going to happen in the markets? What's going to happen in the economy that may drive market returns on stocks and bonds and cash? No idea. Sure. In many ways. I can tell stories about it, but at the end of the day, it's subject to a ton of uncertainty. And so that's why the concept of diversification, of building a portfolio that can withstand different changes, different market environments, different economic results, is really the way to think about that over time. So no absolute number I think you think of as a benchmark, but is the fund sticking to, or ETF, sticking to its approach? Is it giving you a representative return of that investment strategy that you are accessing with the mutual fund or ETF? That's really the question that I think you constantly need to be asking and assessing your portfolio and its contents.
Joel Dixon, who is the Vanguard Global Head of Advice Methodology. Joel, thanks so much for taking the time here with us today.
Thanks for having me, Brad.
Absolutely. Well, we're just a couple of days out from the tax filing deadline. Oh, man. But if you've already filed, you may have already gotten your tax return and your refund back. So if you haven't already spent it on your summer vacation, you may want to use that extra cash too. I know it's going to sound boring, but build your credit. To break down how to use your tax refund for good, Yahoo Finance reporter Kendall Little is here with the good details, the good news. Kendall, what do you got?
Thanks, Brad. So if you're expecting a tax refund this year, you can really use it to get ahead of your financial goals. You know, we've talked about using it to get ahead of your savings or to start investing, but building credit is another way that you can really smartly use that refund. And there's two kind of main ways that we want to think about. So the first one is paying down any existing credit card debt that you have. The higher your debt balances grow, the closer you get to your credit limits, and then that uses up your credit utilization, which is a huge factor in your credit score. So if you can put that money toward your existing debt, then you can really bring down your balances, help your utilization, and hopefully see some improvement in your score. The second main way that we want to think about is opening a secured credit card. And this is a great option if you have no credit at all. Secured cards are a bit different from other credit cards because they require an upfront security deposit, which is where that tax refund comes in. So if you use your tax refund, open that secured card, over time you use it like you would any other credit card, and the credit issuer is going to report it to the credit bureaus. You can build your score, you can start building that positive payment history, and then eventually upgrade to an unsecured card and get that security deposit back.
And speaking of credit cards, there are a lot of credit card options out there. Are there cards with annual fees that are actually worth the annual fee?
Yeah, I think there's definitely times when an annual fee is worth it. It really comes down to making sure that you're getting the value from the card that is going to outweigh the cost that you're putting in. So you really want to look at what the card has to offer. A lot of these annual fee cards have really high rewards rates or really great annual benefits and credits. But if those things aren't on things that you would already be spending your money on, then you're kind of putting extra money on top of the annual fee into the card. So look back at your spending over the past few months. If you're thinking about opening one of these annual fee cards, make sure that that aligns with what you're going to get rewarded on with the card, and then you can kind of align your spending with the card to find the best fit for you.
All right, all things swiping and tapping to pay. Kendall Little, thank you so much for taking the time here today.
Yeah, thanks.
Absolutely. Coming up, everyone, we break down how to avoid the top financial mistakes. Make a list of yours, have them ready for the other side of this short break. March Consumer Price Index, CPI, showing inflation remains persistent, especially in categories that hit home finances. Think about this, namely shelter and gasoline contributed to over half of the monthly items increase. That puts pressure on the chief financial officers of households. Nearly half of American women consider themselves to be just that, the household CFOs, according to an Alliance Life study. All right, now this places added decision-making pressure on where to spend and where to curb spending. As you take control of your money, there are certain pitfalls that you can make to avoid here. Make sure to avoid them. To break it down, we've got Jessica Perrone, who is the Her Financial IQ founder, here with us. Jessica, great to have you here in studio with us. First and foremost, you looked at the CPI report, you looked at some of the areas where inflation was sticky versus where it might have been abating a little bit, but a lot of people at home, especially the CFOs of the households, want to know what are the top tips for ensuring that even in a sticky inflation environment, there are corners that can be cut financially.
Well, I feel like when you know about where interest rates are going to go, especially if you're looking to buy a house, if you know that interest rates are going to stay up for a little bit longer, well, you may decide, I'm going to keep my savings in a high yield savings account and get some interest on that. You may also say, you know what, I'm going to work on my credit score.
Yes.
Because the longer you work on your credit score, the more you work on it, the higher your credit score, the lower the interest that you get on all different types of loans. Right. So you can, once you know where interest rates are going, you can strategize. You can strategize on how to put your money to work to build that wealth.
Certainly. And so what are the small, tiny micro decisions that add up to macro earnings or savings even as we're doing some of that planning?
Oh, you know what? There's just so many ways. But if you think about it, one of the number one pitfalls that women, and almost everyone does, is getting into debt too early. Like when you go to college, you get that first credit card. They have those tables out and they're saying, here's a pom-pom, a school pom-pom, and you can get your credit card. And a lot of students don't realize it's not free money. And they don't understand that this is going to compound. This is going to compound and they have to pay it back. So when you're thinking about saving money, you have to think about not spending as much money and also really looking at your credit products.
If you have to spend, what are the smart spending habits that you can start to implement?
So I would say the number one is to just create a surplus and not spend more than you're making. That's the number one thing to do. Not to. There's a new term that my teenagers are using, and it's called YOLO. Have you heard about this? YOLO.
There's a whole song about it.
Yeah, there is. And I was thinking about this, and they're like, oh, don't worry about it. Live your life. And I'm like, oh, we really have to do this. We have to do this fiscally as well, fiscally responsibly. So I really feel like living within a budget and starting by even just using a budget tracker.
Sure.
See where your spending is going, see where your money is going, so you can see where potentially you can save more.
On the pathway to rebuilding your credit score, say that you've fallen on the bad side of where it currently sits at, what is the first 1, 2, 3 steps even that you could take to start that rebuilding process?
Well, I would say the number one way to do it, there's different ways to look at your credit card debt and look at your debts in general. And there's 2 ways to approach it. You can look at your debts that are the smallest, and you can also look at your debts that have the highest interest rate as well. And so you can kind of sort your debts to see which ones you want to pay off first. But to get your credit score higher, one of the best things you can do is just do that minimum payment. That minimum payment. I mean, you might not make as big of a dent in your debt, so to say, but at least you're starting to show repayment. And that is one of the largest ways to do it. And then the second largest way to do it is just to get your balances down. It really is. So those are 2 tips. There's some other tips too. And these are all tips that I talk about in my Before Investing class as well on how to get your credit scores up.
Jessica Perrone, Her Financial IQ founder. Thanks so much for taking the time.
Thank you so much.
Well, we already know that buying a house can cost a fortune nowadays, but it turns out selling can take a bite out of your wallet as well. Joining us now to break down the costs involved in selling a home is our very own Danny Romero. Danny, tell us, the 3 big hidden costs for home sellers that we may not already be aware of.
Selling a home can be really expensive, Brad. It's about 6 to 10% of the sale price. So for example, if you have a $400,000 home for sale, those costs could range about $24,000 to $40,000. And if you have equity, sellers pay costs out of those gains from the sale rather than upfronting the costs, which some sellers do. And now, if some sellers don't have enough equity in the home, they will have to upfront that cash at closing time. But other costs to really consider: staging a home with nice furniture that can cost you thousands of or even hundreds of dollars, depending on the services that the stager is providing. Another cost to really consider is repairs and upgrades. So depending on whether or not it's a seller's market or a buyer's market, the expectations can shift on whether or not you would have to please that buyer. So that could mean, painting the house, adding more plants to the yard, making it look nice. So there's some costs there. Now, title insurance, this is really important, I thought, protects the homeowner and mortgage lender from financial losses in the transaction process. So as a seller, you could be paying a premium, which could cost you a pretty penny at closing. And another thing to consider is settlement services. So some states require buyers and sellers to use an escrow or closing company to handle their transactions. And in some states, those to handle that, attorneys do it. So those fees can be about 1% to 2% of the sale price. So that could be split between the seller or the buyer. And then one other thing to just point out is transfer tax. Obviously, this depends on the state and local jurisdiction, but there is some form of tax when there's a change of ownership.
Danny, while we have you, there was a National Association of Realtors settlement recently. How does that impact seller costs?
The biggest cost for sellers is paying for their realtors' commission. So typically that's about 5 to 6% of the home's sales price. So for example, if you're selling a home for $400,000, a 5% commission would be about $20,000. But this structure could completely change after the National Association of Realtors settlement. The outcome hasn't been finalized, but it is possible that sellers could pay a lower commission. So you do have a lot more negotiating power over those commission fees, Brad.
All right, Yahoo Finance's own Danny Romero, just out there in the newsroom. Thanks so much for the time, Danny. Really appreciate the breakdown here. Well, streaming platforms are getting more and more expensive, but how much is too much? That's the big question. We've got much more on what you're spending on some of these audio and video streaming services on Wealth after the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Your streaming subscription bills have probably gotten more and more expensive over the last year. But how much is too much? A study from Deloitte showed 55% of Gen Z and 45% of millennial consumers would cancel their favorite subscription should the price get hiked by $5 a month. So, how can you best budget your favorite streaming products out there? Yahoo Finance's Alexandra Canal here to help us out here. Okay. So where are these costs rising to? And let's get some budgeting tips later on.
Of course. So we've all felt the pain of higher streaming prices, especially in 2023. We saw streaming platforms like Netflix, Peacock, Apple TV Plus, Disney Plus, virtually all of your favorite streaming platforms hiked prices in 2023. We also saw cable replacement services like YouTube TV, Hulu plus Live TV raise their respective pricing. Both of those products are now more than $70 a month. And then in 2024, we've been hearing some reports that Spotify is going to be raising prices later this year. So when you add that all up, what do you get? The dreaded cable bundle of the past. It's just adding to our wallets. You mentioned that Deloitte survey, which also said that on average, U.S. consumers subscribe to 4 streaming services and pay about $61 per month. On top of that, 68% of consumers surveyed paid for either a TV subscription or one of those cable replacement services. So this is a heck of a lot of money. We have password sharing crackdowns across the board from companies like Netflix and Disney.
Yeah.
Warner Brothers announced that they're going to be doing a password sharing crackdown soon. I was hit with the Netflix password sharing crackdown. I was one of those
Really?
freeloaders on my parents' accounts.
Oh, well, yeah, many of us, yes.
But because of that, I now subscribe to the more affordable, cheaper ad-supported plan for
Okay.
$6.99 a month. Now, this has been a goal of some of these companies. I do think that could be a tip if you want to save some bucks there. Yes, you have to watch ads, but a lot of these ad-supported streaming services are significantly cheaper, as you're seeing on your screen. So that's one way how you could potentially help to improve the budgeting. There's also a lot of apps out there that track what you're spending on. You could probably take a look and see, okay, maybe I didn't watch a ton of Netflix over the past few months. Does this mean I should cancel the subscription? And then, of course, there's always a good, I'm just gonna subscribe this month because a new season of Bridgerton's gonna come out. I'm gonna binge that, and then I'm gonna cancel the subscription. And that's something known as churn, which is what a lot of these companies are trying to avoid. And that's why they're spending a lot of money on content to make sure that they have enough there to keep consumers on the platform so that they're not canceling and resubscribing constantly.
Yeah, there were some interesting findings within here for sure. You laid out many of the key ones, and by the way, Pinky's out for Bridgerton. But
I'm so excited.
Here was one interesting finding as well. Almost 50% of respondents said that they would spend more time on streaming video services if it was easier to find content. How often have you gone into Netflix or Hulu or HBO Max, whatever, and just said, man, I'm just trying to be inspired and find something that is relevant that I want to come back and binge all the time. But then you just get inundated with so many titles that you say, I'm just going to watch something that's old that I know that's going to make me happy for right now.
The comfort shows.
The comfort shows.
Yes, I do think investing in technology and interface is very important for these companies. Netflix, I do think, does a good job with this because it will suggest different types of shows and movies that you maybe haven't seen, but based on what you previously watched that you could be interested in. And we're seeing a lot more investments in that space. YouTube TV does a really good job with that as well. They have the multi-view feature if you want to look at different sports products. So technology and the interface experience, that is important. It's one thing that Warner Brothers Discovery also emphasized when they merged the Max and Discovery platforms, because you're right, there's so much content available, I think, out there, and you can get very overwhelmed in trying to select what to watch. So if you have little things like the top 10 for Netflix where you can see what's popular, what you could potentially like, I think that helps make the decision a lot easier.
Alec Now, thanks so much. Got your master's green on.
I do.
Big day, big day. All right, everyone, that is it for now. I'm Brad Smith. Thanks so much for watching Wealth here on Yahoo Finance. We've got much more tomorrow at 11 a.m.